December 18th, NYCERS investment meeting is now in order. Diane, will you take it away with roll call?
Okay, Chair.
Here.
Controller's Office.
Present.
Public Advocate's Office.
Here.
Board President Manhattan.
Here.
Board President Brooklyn. Here. Board President Queens. Here. Board President Staten Island. Here. Board President Bronx. Here. International Brotherhood of Teamsters. Here. Transport Workers Union. Mr. Council 37.
Here.
We have a quorum.
Excellent. Are there any last-minute changes to the order here, or are we going to kick it off with the quarterly performance review, Larry?
I have some bouncing around on the executive session, given the weather and people's ability to get in and out of the city, but we'll worry about that later. We can do a public session.
I think we need to make a quick announcement first, though, because we have a visitor joining us today. Can you tell us your name and who you're representing?
My name is Leanna Orr. I'm with the legislative news website, NYCERS. This is Julia Blair's call. Just here to keep the bus open.
Okay.
That's not everything about our audience.
We'll try to make Larry look good in the course of this.
Michelle will help us. Okay, Martin? Yes. Over to you. Good morning.
I have extra copies of the quarterly report. Are we getting any extra copies? So we're talking today about the September quarter. Obviously it's December. As soon as we're done with this, we'll go into October with a hint of November. But in short, September was a very good quarter for the capital markets. While there were uncertain economic conditions, because of those uncertain economic conditions, the ECB in Europe and the Fed here in the U.S. both continue with market interventions, QE here in the U.S., and this had a very positive effect on the overall markets, capital markets. The Russell 3000 is up 7%, I'm sorry, 6% in the quarter, and for the one-year period in September is up over 30%. Non-US equity and developed markets were up 6.9%, and emerging markets were up nearly 9%. Fixed income also did well, because the Fed was buying mortgages and treasuries, and so the investment grade program was up 2%, and high yield continued its hot run, up over 4% for the quarter. Overall, it was a good quarter. You'd be hard pressed to find negative returns here. So, and by the way, within U.S. equity, value slightly negative growth, and large cap is slightly ahead of small cap. We'll talk about that a little bit later. You'll see a summary of the total NYCERS returns. Assets were $43.3 billion, and have an update on that in a little bit. Return for the quarter on the left you see was just shy of 4.5%. That was behind the benchmark of 5.01%, and the one-year return of 17.05 was very strong on an absolute basis, but was behind the benchmark, and we'll talk about some more information in just a little bit. One other piece of data here, other than that the standard deviation was below that of the risk level, was below that of the benchmark. If you look at the 10-year number, bottom office here, the 10-year number is now 8.35%, at least as of September. That's good news. Looking at the asset allocation, we have two pages on the following pages, page 9 and page 10. The difference is the pie chart on the top is the same. That's the asset allocation of 43.3 broken down by asset class. And on the bottom shows how we are versus the wages, overweight or underweight. So if you turn to page 10, which is the adjusted rates, a couple of things I want to point out. Approximately in the 11 o'clock space on the pie chart, you'll see a light green section that was bank loans. Those were funded in the quarter. And you'll also notice that all the asset classes, with the exception of TIPS, were in compliance. Assets were moved, so TIPS, as lying both for October and November, are now in compliance. So other asset classes are within the rebalancing ranges as approved by the board. Are there any questions on the asset allocation? So the next 2 pages show performance attribution. There's a common theme here for the quarter. The performance differential is mostly, and also for the 1-year period and for management period, is mostly attributable to the timing differences in private equity. Obviously, over a 3-year period, it does tend to wash out, so there is some underperformance there. The allocation effect was 8 basis points in the quarter. For the year, it was 52 basis points, and you'll remember, if you turn to the summary of the allocation effects on page 14, the largest number on the page, which is on the bottom of State Street short-term, which represents the cash balance. About a year ago, this will roll off the next quarterly report. We had a high level of cash, so we had a defensive posture, and also underweight in the 4+5 at the time that the 4+5 was doing well. We were comfortable with that at the time for purposes of being defensive in an uncertain market. Obviously, you see that the cash has been put to work. And also, secondly, it was driven by some of the parking places. So, for instance, high yield being a parking place for things like opportunistic fixed income, which are not fully invested. The management effect, the numbers that jump off the page are the private equity numbers, and that's in the short term driven by timing, because the returns that we have are 1 or 2 quarters behind, and in the long run, the 31 basis points, that would be driven by mostly by underperformance.
So, Martin, I'm going to ask you about page 14 and our biggest negative here is the State Street short term.
Yes.
Could you describe how we got there?
Yes. About a year ago, right around September, right around the fall, so as I said, it will roll off the next 1-year period that you see for December. Pardon me. I always wondered what would happen when this rang while I was on camera. Now I know. So about a year ago, the cash levels grew, and that was a defensive posture that Larry was going through every month. The high level, Larry, I don't know if you remember the high level, but it was
About 7.5.
it was upper single digits.
Yeah.
That was put to work later in the following quarter by the end of the year, and certainly by the first quarter we were down, and as you see now, cash is basically frictional cash. But the equity markets did go up. We do have a lot of equity sensitivity in the portfolio, and so the logic there was a lot of uncertainty in the market. The portfolio, if the equity markets do go up, we will participate. It will simply underperform the benchmark, but we had a lot of equity sensitivity, if you remember some of the risk presentations that we had.
And you're saying we lost 57 basis points because we didn't invest in other things? Or
Because we had a cash. Remember, if the markets were going up, and you had
remember we had all the cash and the reasoning for holding the cash was
Right.
waiting and served us well.
So if you turn to page 8, the 1-year return was in the upper teens. Cash is effectively zero. So instead of investing across the retirement system in the upper teens and getting the upper teens return over the last year, you received a return of a little above zero for the cash. Now, that was for only a small period of time in there, but it did have an effect. And that will roll off the next report that you see.
I'm trying to remember, did we do that because the euro was in trouble and the markets then reacted to it here?
That was a big part of it, but there was a lot of uncertainty with questions of double dip and questions of, if you remember the economics charts that Larry goes through, there were lots of uncertainty in the market at the time.
We took profits, some of that cash, we took profits in the spring of last year, like March, April. We had a very big profit in high yield. I think we were at the high end of the range. We took it to the low end of the range. And rather than reinvest it, we kept it in cash. And there was a point, if you all remember, it was last November. All the markets went down. It was one of those really stressful periods. I think people thought the euro was going to blow up. So we were defensively
also some of
The
the,
question I'm trying to ask though is that the reason that this is showing is because we were over allocated cash at the time.
Correct.
Right.
And that's because if we hadn't been over allocating cash and we had the money to spend other places.
the allocation effect would have
Right, we
been,
would have been up 57 basis.
I don't know if it would have been in full 57. You see some pluses and minuses, but it would have, that was the bulk of the under allocation effect. Also, as I mentioned, some of this was driven by parking places as well. On pages 16 and 17, we show how NYCERS did versus other large public funds. So on page 16, we show, and I'm looking at the column over here all the way to the left. In blue, it's you see that the returns are fairly compressed. The return placed you above median, but the fourth column to the left, which is the one-year number that we were just talking about, Al, the 1705, placed you in the top quartile. So even with the cash, you had top quartile results.
Very nice.
And the 3, 4, 5 year returns just outside the top quartile above median. The next page shows the returns for the years ending September, and you see similar numbers there as well. So unless there are other questions about this, I'm going to turn it over to Seema for the equity
That's a question.
portfolio.
So you pointed out earlier that for 10 years, in September, we were 0.5%.
Yes.
So on this chart, are we in the top quartile there? Can you tell?
We're in the 34th percentile.
Oh, I see.
Again, this is depends on what you're measuring. This is public plans greater than 10 billion.
Okay, thanks, Martin. So if you would turn to page 21. This shows you your domestic equity allocation. So basically, you can see in the pie chart that the majority of the money is in passive. But if you look down at the sectors below and you focus on 3 columns, the index return, the actual return, and the difference column, just a couple highlights. Martin mentioned this earlier, but the U.S. markets had a very strong quarter in September, as shown by the Russell 3000 Index Fund being up over 6%. If you look in the difference column, just a couple highlights there. No big moves here or there, but in small cap active, which is the first row, and then small cap fundamental, outperforming by over 100 basis points relative to the benchmark. So some good numbers there. If you then turn to page 28, which is your international allocation. You can see here in the pie charts above that, as you know, on the international side, NYCERS is more active than passive, which is the opposite of what's going on in the U.S. And again, I'll point you to a couple of the same columns, the index return, the actual return, and the difference column. And you can see, again, as Martin mentioned, both the emerging markets, which as you can see is the last row, passive EM, up nearly 9% for the quarter. And then EFA passive, which is further up in the rows, up close to 7% for the quarter, both stronger than the U.S. All good numbers, though. And then if I just point you to the difference column, I'll just highlight one thing. If you scroll down several rows, non-U.S. activists underperforming by about 400 basis points. That's your one manager governance for owners, and we'll discuss that more in executive. And then if you turn to the next page, 29, goes through some detail on EFA. As you might remember, we completed the EFA search recently, and we're looking to fund those new managers in the coming months. So the numbers here, the trailing 3 months, the fiscal year to date, trailing 12, and then the 3 and the 5 year. You can see where the NYCERS is the purple bar and the index is the yellow bar, and so outperforming in all those periods relative to the benchmark. So that's been a good track record there. If you then turn to page 36, which is emerging markets. And you can see here, NYCERS is benchmarked to the FTSE Custom Index. And if you look in the trailing 3 months, fiscal year to date, trailing 12, and trailing 3 years, again, the blue bar being NYCERS portfolio, the yellow bar being the index, doing well in the portfolio relative to the index. And we actually have now more than 1/4 of the performance of the new emerging market managers that NYCERS hired as a result of finishing the emerging market search earlier in the year. If you then just turn to the next page, which is hedge funds.
Before you move on, Sima, can I ask you a question on 36?
Sure.
So for the trailing 12 months, the difference between passive equities and emerging markets, the underperformance, is that due to the country restrictions?
There are country screens.
So I think, if I may, we have an item in executive session which might fully, and I'll let you maybe talk to it, the analysis that you did does talk about that?
I don't know that it gets to passive. I was actually
Okay.
going to wonder that too. I guess is the
custom-
passive portfolio run against the custom benchmark?
Yeah.
It is. So it's not mismatched to the benchmark. It was underperformance by the passive manager during that quarter.
That's right.
Okay, so it's not a matter of us getting benchmark to a broad index that say includes China and Russia, but those kind of other factors, such as expenses, partial sampling, instead of full replication in the index, etc.
Well, we're just showing the difference between the custom benchmark and the MSCI Emerging Markets Index, which we always show. And historically, not unlike what you see here, the custom benchmark has done better in many periods versus just the standard benchmark. That's all I'm showing.
Okay. I can bring it up with you later. Thanks.
Okay. Okay, the next page, 37, is hedge funds. Again, very early days in the portfolio. So the trailing 3 months, the fiscal year to date, basically, a little better than one benchmark, about in line with the other benchmark. The trailing 12-month period doesn't really have the full effect of a lot of the direct investments that we've made. And so over time, this chart will start to reflect more of the portfolio. So now I'll turn it back to Martin.
On page 39, we have a summary of the fixed income allocation. It's 1/3 of the portfolio, over $14 billion. And you'll see in the pie chart that it's dominated by the investment grade portfolio, represented in green. On the following page, the investment grade portfolio is broken down. That's 18% of the total fund, over $7.7 billion. You'll note in the chart below that the over-underweight column, and we've gone through this in prior months, we're underweight the treasury sector and overweight the credit sector. In this particular quarter, that worked out very well, as credit did well, as you see, returning nearly 4%, while treasuries had a positive return, but it was less than 1%. Also in the difference column, you'll note that all the numbers are positive. We have 14 managers, 12 outperformed, 1 matched the benchmark, so only 1 of 14 managers are actually behind the benchmark. So it was overall a good quarter, which you can see the total results on page 41. On page 41, you see the results were positive 2.6%, over 50 basis points ahead of the benchmark. For the year, a return of 7.81, well over 100 basis points ahead. And for the 3 and 5 year number, over 8%, returning well over the benchmark as well, with volatility slightly below that of the benchmark. So the returns here for the program have done well. TIPS on the next page did well. The returns were slightly ahead of benchmark by 14 basis points, but a positive 226. For the year, very strong results, returning 942, also ahead of the benchmark. Similar results for the 3 year number. And since inception number, we started this program in 2005, returning 679. High yield, page 43, continued hot results, returning 422, 10 basis points ahead. You'll recall we have a slightly new manager lineup. The 1 year number is just shy of 17%. That was behind the benchmark, and the 3 year number was 1202. What I do want to point out, like I pointed out for the overall fund, 8% for 10 years. If you take a look here, 10 years for high yield, 10 year result for high yield is 10%. and that's also ahead of the benchmark. So the high yield program has done very, very well. Convertible bonds, we'll talk a little bit more about this in executive session. It's on page 44. While the volatility is below that of the benchmark, for the quarter, we matched the index's return of 4.52%. The one-year number, however, we were behind by over 200 basis points, returning on an absolute level a good return, 14.17. And you'll see we now have a four-year number that's over 9.5%, but that's also behind the benchmark. And as I mentioned, we'll talk a little bit more about this in executive session. Opportunistic is on page 45. Like private equity and real estate, a lot of these numbers are lagged, so the longer-term results are more meaningful. But for the quarter, the results were positive, ahead of the benchmark. The one-year number was 635, but as you see, the 3- and 4-year numbers were very strong and ahead of the benchmark. This program, of course, as we talked about before, is in the process of being built up, so over time you'll have more meaningful numbers as well. The next few pages show the emerging and developing managers. Page 46 is developing manager, LM Capital, and page 47 is progress. And both of those numbers, as you see, both of those managers, as you see, the blue bar, which is the manager results, are quite good over all time periods, beating the benchmark. So the program for developing and emerging managers for fixed income has worked very well. Unless there are any questions, I'm going to turn it over to Holly, who's here for Kathy, for ETIs.
So if we look at page 48, your ETI returns outperformed for the quarter net of fees and for all the other periods. If you turn to page 6 in the other book, you see the PPA activity for the quarter, page 6. The highlights here is that during the quarter you had new investments of $17.8 million that was delivered in that quarter, if you look down at the second quadrant of boxes. Another highlight is that you also committed $7.5 million of investments during that quarter. Yes, the big book. That's page 6. And page 8 of the same book, we look at I would like to bring your attention that this is the last quarter we'll report on the HIT home program. This is the final report that the HIT had was a 10-year home program which provided low-cost, sensible mortgages to New York City union members and municipal employees. And the program ended, and over the 10-year period, we provided 914 mortgages to NYCERS members. We're actively talking to the HIT about establishing a HIT Home 2 program, which would specialize on homes in the affected storm area. So we're actively talking with them about that now. And if there are no questions?
There is.
Yes.
On page 9 in the big book, we seem to put a lot of money into Manhattan, more than the other boroughs. Right?
Is that page 8 or page 9?
Well, it looks to be 9 in this book.
Okay, no, we got it.
Manhattan has 169 million, I guess, to whatever, the rest of it.
Well, those are workforce investments, and those are primarily Michelamas, and it just turns up that the ones that's showing up in the program is in Manhattan. Yes.
What did I say?
More than that.
Are you also looking at
But Pat, you have a good point. You have a good point. There shouldn't be zeros in these other boroughs.
So why not? Are you also looking at PPAR for areas affected by Sandy?
Yes, we are.
I understand.
Aggressive. There are no other questions? Thank you.
Okay, so moving on to page 16, we'll talk a little bit about the highlights of the real estate portfolio for the second quarter.
Big book?
Yes, page 16. Actually, I'm going to probably stay on page 16. There's several pages that follow, but I'm just going to give you the highlights, and I'm going to talk from page 16. So the NYCERS allocation to real estate is 6%. Currently, or as of second quarter, we're 4% invested, 5.4% committed. In terms of the portfolio, the market value of the portfolio, about $1.7 billion in the ground. We have about $500 million, $500 million in unfunded commitments. Together, our exposure to the real estate asset class is about $2.2 billion, which is comprised of about 40 investments, 27 managers at work for you. In terms of how the real estate markets are performing, real estate fundamentals continue to move in the right direction, slow but positive. There's limited new supply coming out of the ground, so construction is limited at this point, which sustains a good level of demand. You see occupancy inching up across property types, office, retail, residential, and industrial. Investors who earlier this year we were talking about were just pursuing stabilized assets in prime markets are looking for yield, and so they're looking beyond New York and San Francisco and venturing out into other cities such as Austin, Seattle, and others powered by tech. So as we kind of look at performance for the quarter, NYCERS posted a quarterly return of 2.1% net, which was about 20 basis points, a shade under the Odyssey, which came in at 2.3%. But as you look down at the graph on the bottom, which depicts NYCERS performance in the near and for extended periods, NYCERS is in blue and the benchmark is in yellow. As you can see, I just talked about the quarterly performance, which are the bars on the left. I'm moving from left to right. But as you can see, for the 1 year, the NYCERS portfolio outperformed by 210 basis points. Also for the 3 year, by 150 basis points. That 5-year number kind of is a blend of, has some global crisis impact in there. But since inception, we're evenly matched with the benchmark, and this report is on a time-weighted return basis. The inception date for the portfolio is 2002. So I guess soon you'll be seeing a 10-year number. But right now, the since inception number only covers up through 2002. In terms of our investment activity for 2012, we have about $320 million committed. You have a new investment that you're going to hear about later in the program. And that concludes the highlights on the real estate portfolio. If there are any questions.
Hey, Don, just to clarify, you stated that the performance numbers were time-weighted. Mm-hmm. They're not dollar-weighted?
They are not dollar-weighted. The Odyssey is a benchmark that's reported on a time-weighted basis. We also have information on a dollar-weighted basis. The portfolio is about 2.2% IRR net, 1.2 times multiple as of the second quarter 2012 on a dollar-weighted basis.
Okay. The terminology used at the bottom of page 2 of the report, where the NFI Odyssey value-weighted index gives the impression that the cash flows were matched to the timing of our investments. So, but they aren't. Mm-hmm. And the numbers reported for our portfolio, are they dollar-weighted, or are they also the time-weighted numbers?
They're the time-weighted numbers.
Okay. Thank you.
Okay, so with that, we're going to turn to page 25 in the big book. Talk briefly about private equity, since we're talking about the quarter ended June and we're almost ended December. So again, on page 25, talk a little bit about the returns. So the IRR as of the end of June 30th, 8.2%, a multiple of 1.26, effectively remained flat from the previous quarter. If you look on page 26, is the benchmarking exercise. Again, these numbers are as of June, so if people remember from the last board meeting, we made a recommendation that was approved to change the benchmark, but this was the prevailing benchmark at the time. 8.2%, the Russell 3000 plus 500, 11.1. Outperformed the median IRR, continues to underperform the upper quartile, but moving in the right direction. From there, if you go to page 37, this is what the overall portfolio looks like from quarter to quarter. The takeaway from page 37 is if you look at the contribution and the distribution numbers, that's probably the most important factor here. Net distributed capital for the second quarter, 163, contributed capital, 143. So distributions are outpacing contributions, so that's positive, so it's generating positive cash flow. Again, that happened in the previous quarter as well. And if you look at it just kind of year over year, you're seeing as a portfolio gets more seasoned, frankly, there's just more money coming back. So moving in that right direction. If you go to page 38, this just gives you a little bit more granularity of what the portfolio looks like. So at the end of June 30, if you look at the bottom portion where it says total portfolio, 93 managers, 138 funds. The DPI, which is the distributions paid in, that's the third row from the bottom, that says 0.46. So really what that means is for every dollar you've put into the portfolio, you've gotten 46 cents back. So again, you would expect that number will continue to grow, moving in the right direction. And then finally, if you go to page 40, 40 is what the overall returns look like on a 1, 3, 5, 10-year and since inception. And again, kind of make the same comments I made in the previous quarters. You know, the 1, the 3, the 5, they don't really matter. Private equity is a long-term asset class. The best way to look at it is since inception, because again, exclusive of using the secondary market, it isn't a liquid asset class. So continuing to move in the right direction, relatively flat, underperforming the benchmark, negative 2.9%. But again, as you look at all the recent commitments you all have made, it's going to take a little bit of time for those to kind of see the returns. And then finally, I would go to the last page, which is 48. 48 is a pie chart which shows what the portfolio looks like public versus private. The reason I bring that up, and I have brought it up in the previous quarters, if you look at a portfolio that becomes more seasoned, there frankly is just more public companies. So you end up with a mix that's probably 75% 25, so 75 private, 25% public. So that's kind of the mix you'll get to. As you see that spread change, you'll just see that the portfolio is more seasoned. And with that, that's the update again, because this is as of June, so I would open it for any questions. If not, turn it over to the next person.
Anything else on the board list? Okay. So let me.
Callan's gonna do it.
Callan. Oh, sorry.
Yeah, as Mark hands out our performance report, it's also in the big package on page 53. Just a quick introduction of Tom Shingler. Mark and I are going to be talking about a number of different agenda items, but Tom is with us today. Tom is going to be talking about the contrarian memo. He works with us, been with us for about a year and a half, and he's got a very strong fixed income background. So with that, if you turn to page 2 of the performance presentation, you've seen this over the last number of quarters, and we're building a history here. If you recall, a year ago in September of 2011, after the asset allocation study, we established the new long-term target. And page 2 just reflects what the new long-term target is versus where you are as of September 30th, 2012. And then it also reflects your asset class weights compared to other public funds, large public funds in our database. And then at September 2011, we also realized that a number of the asset classes were not completely full up to the target, and so we established an interim target benchmark, which basically said, okay, for those asset classes that did not have a full weight, like real estate, for instance, we took the difference between the actual and the long-term target as of September 2011. The difference between those two was then figured out where those assets are going to be held over the interim period. And for real estate, for instance, it was split halfway between domestic equity and core plus 5 fixed income. So that's how we established the interim target. That's shown on page 3. And then page 4 begins the attribution analysis for the quarter ending. Page 4 is against the long-term target, and page 5 is against the interim target. And again, this is for a very short period of time. It's just the quarterly attribution. And because of the noise that is surrounded around private equity, we actually made the target return equal to the NYCERS return, just to avoid any of that heavy dislocation between the two. And so the actual return was 449, which was slightly below the target return of 456. In the aggregate, the managers actually added a basis point versus the target, and then the deviations from your target return was a detraction of 9 basis points. When you look at just the manager effect, you see a positive attribution coming from the structured fixed. You see a negative attribution coming from real estate. When you look at the style allocation, which is the deviation from the target, the overweight to domestic equity and the underweight to structured fixed was a positive. The overweight to short term for the quarter was a drag on performance, and then the overweight to private equity was also a drag. So that made up the biggest differences between the target return. Page 5 is the attribution analysis versus the interim target, and the difference there being that the manager effect is actually a negative 2 basis points, and then the style allocation or asset allocation effect is less than it was against the long-term target.
And to clarify, the manager effect is before or after manager expenses?
It's before.
Thank you.
Page 6 and 7 has the longer-term attribution going back 1 full year since we started this analysis. So page 6 has the attribution versus the long-term target, and page 7 has the attribution versus the interim target that I've talked about. And over the 1-year period, the performance did drag behind the target return, 1705 versus 1711. The managers in the aggregate, however, did add 24 basis points. However, the deviation from the target was a drag of 29 basis points, with much of that coming from the short-term allocation that Martin talked about earlier. Also, the underweight to opportunistic fixed was a drag of 26 basis points. But you also see positive attribution coming from the overweight to domestic equity and the underweight to structured fixed that added value.
Question for you, but
yes.
And maybe Martin, as you could chime in on this as well. I'm looking at the quarterly book, and page 12 of that, there's a 12-month attribution, which I believe is provided by BNY, and I'm just noting the difference in attribution source estimates, and wondering if you could maybe speak to the methodology differences. 12. So 12-month ending September 30, 2012.
I believe the difference, and Martin can correct me if I'm wrong, but I believe the difference is that we hold the targets the same starting at September 30th, 2011. So the long-term target started that date, and then the interim target also started that date. And we didn't adjust it quarter to quarter as things have moved. And I think Martin's target has adjusted.
Bank of New York adjusted every single month versus the adjusted policy. But if you look at the numbers, they're directionally in the right direction, comparatively speaking. But that is the primary difference.
So it's kind of a target for...
It's more time. Bank of New York is using more data points.
Yes.
And Canlon's using fewer.
Okay.
Justin, that relates to the allocation effect, though. The management effect is where the real substantial difference is, because, again, what Bank of New York is doing there is using the actual private equity return versus the Russell 3000 plus 500 basis points. That's the noise that Bud talks about. If you remember, the Russell 3000 last year, during the trailing 1 year, was up 30%. At the 500 basis points, private equity would have had to perform 35% during that trailing 1 year in order to be a neutral effect. That is the noise that we talk about in private equity. And so for our attribution for that there, we simply use the actual private equity return as the target also.
And some of the differences there can be attributable to the now not insubstantial cash flows that we have in private equity. In other words, money coming in, money going out.
Okay, that makes perfect sense. Thank you.
So continuing on with the presentation, on page 8, we see the total fund peer comparisons against our database of public funds greater than $10 billion. And similar to what Martin showed in the Boney database, you've ranked in the top quartile over the last 1 year, 2 year, 3 year, slightly below the top quartile, but in the 37th and 36th percentile over the 4 and 5 year periods. Page 9 shows the peer comparisons, but on an asset allocation adjusted basis. So what we're doing here is saying, well, what if everybody in the database had the same asset allocation as NYCERS? So what this is driving at, it gets to more of the focus on your manager's performance. And you almost have to take like a relative look. So from page 8 to page 9, your ranking over the last year is the unadjusted is 23rd percentile ranking. Your adjusted is the 16th percentile ranking. So that's an improvement, which is saying your managers have performed better than other funds in the database. The 2-year number slightly goes down on an adjusted basis, so that means the managers were slightly worse. The 3-year is basically the same, the 4-year is slightly worse, and then the 5-year there's an improvement from 36th to 30th.
Buzz,
Yes.
when one looks at this, the question that comes to mind is, who are the managers? Have we made the changes to the manager base? And is that the reason why an improvement has occurred?
Yeah, well, this synopsis summary does not get into the specific manager performance.
Yeah.
Our larger book that we send out on a quarterly basis has that information. I would have to summarize that for you as to what accounted for the difference.
Yeah.
Pat, you bring up a good point. When I look at these numbers, I'm starting to think, we've terminated a lot of underperforming managers, and I think it's slowly starting to come through the manager effect. You don't have the drag of the bad managers. It takes time to come through, but this is pretty good for
Well, we're moving in the right direction.
We're going in the right direction.
Page 10 looks at it, the peer comparison on a calendar year basis. And just one highlight I would say is over the last few years has been all strong. The 2011 period was not strong relative to peers, but still at the median percentile, 50th percentile. Then the next few pages break down the public markets, and starting on page 11 shows the total domestic equity versus other public plans of $10 billion and better. And you see that the performance is tracking very closely to the benchmark, which began in September 30th, 2011 to be the Russell 3000. Prior to that, it was a combination of 90% Russell 3000 and 10% S&P 500. Given the index-like performance, the rankings, the relative rankings versus the peer group change over time. And so over the last few years, it's been a third quartile type performer. However, going back 5 years, it's above median, yet still index-like. Page 12 shows the calendar year numbers and the risk-adjusted numbers at the bottom of the page. Page 13 reflects the international equity component, and you see the improvement that SEMA talked about over the last year with performance ahead of the benchmark and also ranking near the top quartile over the last 1 year period, which has helped the longer term numbers. Page 14 shows the calendar year for international equity and the risk-adjusted numbers. And page 15 has the total fixed income against the long-term fixed income target. And again, similar to the total fund, we've done a similar exercise because you haven't funded up opportunistic fixed. And so there's an interim target shown on page 17. So 15 and 16 is against the long-term target. And the relative rankings are very strong. The rankings versus the target have trailed over the last 1 year period, mainly because of the high yield and the opportunistic fixed underperforming over that time period. However, longer term numbers are better. 16 has the calendar year versus the long-term target, and then 17 has versus the interim target, and the performance is not as big of a drag versus the interim target due to the fact of the holding places. Concludes that report.
Any questions about Callan? Thanks. Okay, I'll quickly update everybody for the October numbers because we just spent an hour on the quarter. So quickly, if you go to page 39 in the quarterly report, in the monthly report. Sorry, I said quarterly, I said monthly.
Everyone should have them.
Monthly, my mistake.
We have some extras here.
$39? Yeah, 39 in there. It should be the market indicator page. Yeah, for October. So if you look at the far left-hand column, these are the markets since the September numbers you just saw. Basically, the equities, all the markets were down a little bit, basically. So then, not surprisingly, if you jump to page 41, which is our results for the month, we were down a little bit. We were down 27 basis points, so that the fiscal year to date, which is 4 months, is now up 4.2%. Similarly, if you go back to page 40, you can see that after the election, by the end of the month of November, the markets are kind of stabilized and we're up a little bit. December, the markets are kind of up. So far, we're sort of up. We're north of 5% up, sort of halfway through, or a little more than halfway through December. So if the markets stay where they are, we'll be up, again, for 6 months over 5%, which is pretty good. Calendar year basis, which again, we always talk fiscal, but on a calendar year basis, we're up about 14%. So I think we're sort of set up right. We're within all the bands on the asset classes, so there's really not much to talk about in the month of October. Seema, anything interesting in October?
No.
Martin? No. Barry?
No. Did you guys rehearse that?
No, there's not much to say.
No.
Beautiful. You guys did a great job. So anybody want to talk about any questions on October, or we can just kind of motor right along? Thanks. Okay. That ends the results. We have Infrastructure 102. Remember, we had Infrastructure 101 course last month. There was a request for a little more education. So we have people from JP Morgan Chase here who do infrastructure investing. And they're going to talk some more about what makes the market move in infrastructure. Some of their experience, although I've asked them to keep the commercial down to a minimum. And feel free to ask them any questions. And this is part of our education on the infrastructure asset class. Then we're going to talk about how infrastructure fits into our asset category, which we're going to call make infrastructure part of real assets. Then we're going to go through the real asset IPS. So where's Petya? Potential went together.
Be in the other room.
Evan here? All right.
No, surely not. I see. Oh. I forgot one good out of that last night. I was at the computer after talking to you and stuff.
Good morning. Perhaps we can start with some introductions.
Sure. Good morning. Thank you for having us. We're with JP Morgan. As you turn to page 1 in the presentation that you have there, my name is Stephen Weddle. I'm one of the client portfolio managers for infrastructure. I advise clients on the rewards and risk associated with infrastructure broadly, globally, as well as in Asia and maritime. I'm joined today with Mark Weisdorf, who is the CEO for our infrastructure investments at JP Morgan. He was principally responsible for starting up our efforts at JP Morgan, and prior to that, he was with the CPP Investment Board in Canada. And as you might be aware from what Petya and Evan have done in terms of their first presentation to you, the Canadians have been well advanced in infrastructure along with the Europeans in contrast to the U.S. market. So today what we'd like to do is to build on Petya and Evan's presentation to you in terms of Infrastructure 101, and as practitioners give you some views as it relates to what's happening in the infrastructure markets today, some of the risks and mitigations to those risks, the market outlook and what we're seeing, and take you through a few case studies to emphasize what we see as it relates to the marketplace. And no one could be better at that than Mark Weisdorf, and with that I'm going to turn it over to him.
Well, thank you very much. Thanks very much for having us this morning. I'll try and keep my remarks to a minimum and leave plenty of time for questions, but there are a few themes I would like to cover. First of all, I just wanted to mention that I've had the pleasure of living in New York for 7 years now. Moved my family here. One of my daughters lives in Brooklyn, and the other one is about to leave us and move to Brooklyn as well. She won't be moving too far afield. If we turn to page 3, please. Infrastructure offers what we would suggest would be, on average, lower risk returns than many other investment strategies. And that's because the sorts of assets that we invest in are assets that are either outright monopolies, pure monopolies, water and wastewater, electricity, gas, or assets that have monopolistic characteristics aren't pure monopolies, but assets such as transportation assets, toll roads, airports, and the like, assets which are very capital intensive, that are regulated in some form, either for environmental regulations, zoning regulations, and other regulations. But within infrastructure, there is a spectrum of risk and return. And page 3 identifies some of the drivers that do impact risk and return, and where on the spectrum our core plus strategy focuses. And as you say, you can invest in infrastructure at the core end of the risk spectrum, lower risk, lower volatility returns, higher proportion of total return coming from cash. You can invest at the opportunistic end, the higher risk end of the spectrum, where you might take development risk, you might be seeking capital gains rather than growing cash flows along the spectrum. So if we look at subsectors, Regulated utilities, which are pure monopolies, would be at the lower end of this risk spectrum. There are few economic drivers. Even during the worst of this most recent recession, we all continued to take showers. We continued to watch our HD TVs or use our computers. We continued to use gas to heat our homes. So pure monopolies at the low end of the risk spectrum. Telecommunications is also infrastructure. We use telecommunication systems to move data and voice, critical to productive community. However, there are competitive dynamics involved in telecommunications. You can have satellite, wireline, wireless, and so it would be riskier, if you will, on the risk-return spectrum. And transportation assets, as I said earlier, would be in between. They are more economically sensitive than regulated utilities, but certainly less economically sensitive than, say, telecommunications assets. Geographic drivers are another thing to look at. The legal systems, the regulatory systems, and the political backdrop is very different in different economies and different countries around the world. And we would say the developed markets, countries in the OECD, US, Canada, Western Europe, Australia, New Zealand, would be countries, they are slow growth economies, but they are countries with very well developed legal and regulatory systems. Now, I should state that even within those regions, there are riskier subregions and less risky subregions. And for example, in the United States, there's about 30 states that we would invest in with respect to regulated utilities. There's about 20 states we'd be less interested in investing in because there isn't a 30 or 40-year track record of regulatory decisions by those regulators in those states that give us the confidence that we'll have a fair return on capital for capital investment in their regulated utilities. And the same thing is true of the European Union. There's 25 members of the European Union. There's about 10 countries that we would not invest in, principally the Central European countries, who do, and there's another 15 that we would, because they have regulatory regimes that they've been operating for 20, 30, 40 years that give us confidence that the decisions made by regulators will offer a fair return on capital.
Would you elaborate on Central Europe? Was that because the communists were in control of the governments there for those years?
That's correct. The Central European governments, and I was born in Poland, so I have some direct experience. I moved when I was very young to Canada before I moved to New York 7 years ago. But and the Polish economy has done quite well, actually, over the last 10 years. It's one of the few economies that has not gone into recession during this most recent fiscal crisis. Nonetheless, you're just using them as an example. They've only had 20 years, really, since the Berlin Wall came down, since Glasnost and so on. And it's just not a long enough track record to give me the confidence that I can get by looking at investing in a country that has a 40-year track record of private sector regulation and legal system. I am very conservative. I'm a former accountant. I like to sleep at nights, and for a core plus strategy, what we're really looking at is downside protection. We're looking at not high nominal returns, which usually involve taking risk, but high risk-adjusted returns. All right, I want to be clear. We're not against investing risk to get higher returns. We also have on our platform an opportunistic infrastructure strategy, investing in China, India, countries in between. We will take development risk. We are investing in emerging markets, if you will, as it says on the right side of this geographic page. The potential returns investing in those markets are higher, but we are taking much more risk. We're seeking capital gains over a period of time. And so it's a different risk profile and a different risk return.
You mentioned Russia.
I didn't mention Russia only because it's not, again, it would be in the higher risk, higher potential return category. But I was just using Poland as an example. And Russia's not a member of the OECD, so that's another reason I didn't focus on that.
Just for a client that is looking for a blended risk, opportunistic, et cetera, I assume you have clients who invest in both strategies.
Absolutely.
Their core and blend that according to their own risk.
We do. I mean, historically, what we've seen, what we've seen is that most investors, when they're approaching a new strategy, prefer to start with something at the lower risk end, get comfortable, grow, get experience, and then they start to add what we call higher risk strategies on top of that, maybe 20%, 30%, and over time they might add more.
What's that return profile for core? Surplus.
We believe that target rates of return are available on average in the range of 10 to 12% gross returns, and these are levered returns. Okay, 10 to 12% nominal returns are available. Lower returns for regulated utilities. Allowed rates of return for regulated utilities in the United States range from about 9.5% to 11% on a wide average across the 50 states and the FERC, the Federal Energy Regulatory Commission, which regulates interstate transmission of energy. And for transportation assets, which are more economically sensitive, again, the range of returns can be from 10-ish% for certain toll roads to 14, 16, even 18% for certain ports assets. Now, these are more economically sensitive. They require more management. They are, in effect, riskier. But a blended return, a diversified portfolio that has both a diversified number of regulated utility assets and diversified in transportation assets, diversified by geographies as well. We think, diversification is one of the few things that have been proven reduce risk. One of the few things in investment that you can actually prove mathematically. And so diversification is the key. And so diversifying both by subsector and by geographic region is key to diversification. The last thing I would just say on this page, which I suspect you've heard before from Petya and the team here, but clearly new development, greenfield development, if you will, of new assets is taking on more risk, hopefully for more potential return, but is taking on more risk than buying existing assets that have a 10, 20, 30-year track record of operation. If we move to pages 4 and 5, we're going to hit the risks head on here. These are not risk-free. This is not a risk-free investment strategy. We believe it is a core infrastructure strategy is lower risk than many other strategies for the reasons I outlined, but there are risks, and that is why the returns are higher than what you can get on a 30-year U.S. government bond today. So there are regulatory and political risks. And there are mitigants to those risks. That is doing deep due diligence to determine not just what the legislation and the regulations allow for in those different jurisdictions, but what the precedent regulatory decisions have been. Asset performance can vary, and what you need is a manager who is knowledgeable in both acquiring assets but also operating them and managing them. Liquidity. This is not a terribly liquid asset class. We're talking about investing in private, direct access to these cash flows. But there is, therefore, a premium available for those people who have a longer-term investment horizon and can invest some of their portfolio in illiquid assets. This is a new strategy with not as much robust data that does exist, for example, in terms relative to public equity markets or public debt markets. However, again, building a well-diversified portfolio in assets with monopolistic characteristics protects against that risk. And also, if you're investing with knowledgeable managers, you have the opportunity to earn excess returns because you're investing in what is still today an inefficient market. Investor liquidity can be mitigated depending on the type of infrastructure strategy you invest in. We talked about development risk, which is only a factor if you're doing opportunistic, taking development risk. And then, of course, there's corporate governance. And again, that comes down to your manager and how your investment manager manages interactions with its investee entities and with you as investors. Page 5, I think we've covered a lot of this. Clearly, at the core end, we're focused on growing cash flows, investing in existing assets in regulatory jurisdictions that have been in existence for 30, 40 years, whereas opportunistic, we might be investing in emerging markets with newer regulatory jurisdictions. We might be taking development risk. And then there is value added in between, and some investment managers, including ourselves, will do some value added investing. And what value added investing is really investing in existing assets but that have the potential for expansion, the need for expansion. And if you expand an existing asset, add to a toll road, expand an airport, add a runway, then you have the potential to generate more revenue and to generate higher return. And it's a lower risk way of generating returns on core strategies. Page 6, I think, again, we've covered much of this, but on the risk-return spectrum, we would say social infrastructure, and there isn't a huge opportunity to invest in the United States yet in social infrastructure, but some of that may be coming. There are a number of states talking about whether a public-private partnership may make sense in rebuilding some schools in some states. Certainly there has been investment in military facilities for several years where the government hires the private sector to come in and build and then operate military housing. And there was a courthouse done in Los Angeles recently. These are lower risk. This is where a creditworthy government agency is paying the lease amounts, the rent, if you will, throughout the lease term or the concession term. But as you can see, there's also, while they are lower risk, they're quite low return. I would suggest that the returns are similar to I call them government mezzanine debt. It's what you could get on government bonds plus 100 or 200 basis points. We think the more interesting space is in the regulated utility and the transport sector. And again, it's building a diversified portfolio of those strategies. Let me turn to Seth. Question.
Could you speak to what are the opportunities for infrastructure in New York for investing? I mean, you've talked about globally, but I don't know if you noticed the name of the fund. But, we have a little bit of interest in what's going on here in New York.
No, and certainly, and we've, we're being based here in New York. We've spent a great deal of time with a number of government agencies and participants, interest groups in New York's infrastructure. There's very limited opportunity thus far in the state of New York and in the city of New York. The Tappan Zee Bridge has been discussed for over 10 years. Most recently, there were significant consultations with the government's office. So far, it looks as though the governor is planning to pursue rebuilding, if you will, the Tappan Zee Bridge without private sector funds. That may change, that will evolve, but so far that opportunity is not arising. We think the biggest opportunity continues to be refurbishment of government buildings, making them clean, green, more energy efficient, better environments to live in. There has been some discussions outside of New York City with respect to schools. Yonkers, there's been some discussions about the possibilities there. But at this point, these continue to be exploratory discussions. I wish there were some near-term opportunities. There has been one or two transmission links done to bring electricity from New Jersey or elsewhere into the city of New York. So there have been from time to time some opportunities there. But the opportunities in New York City and New York State to date have been muted, have been modest. Ports of New Jersey and New York are another opportunity. They need to get ready for the Panamax-sized vessels as the Panama Canal is being widened. Should be completed by 2014. There's dredging and bridge raising and terminals that need to be developed in the ports of New Jersey and New York, and so there may be some opportunities there. But it's still relatively limited in New York at the moment.
If I could dovetail off, I'll get to your question right afterwards. David's question. speaking to the opportunity set you see, what do you imagine, or what percentage of deals do you imagine will be public to private over, say, the coming decade? I ask because, my understanding of the infrastructure, America's infrastructure funding needs is somewhere in the ballpark of 2 to 3 trillion, perhaps over the next decade or two. We're all familiar with the country's public sector fiscal woes, so it seems kind of hard pressed that it's going to come out in the public sector entirely.
Right. Well, we do think there will be an increasing percentage of funding that comes from the private sector, but to suggest that necessarily that the United States will offer the same degree of opportunities that Europe or other places do, I think would be aggressive. The principal reason is that in the United States we have tax-exempt debt, municipal debt, and government agencies are used to issuing tax-exempt debt, which is quite a low cost and efficient cost of capital. And so long as retail investors, taxable investors, will buy tax-exempt debt at the low interest rates that that debt offers, you're going to tend to see a disproportionate amount of funding coming from tax-exempt debt. In a sense, this is a public forum, so I should be thoughtful about how I articulate this, but in a sense, states and government agencies are having their cost of capital subsidized by the federal government by issuing tax-exempt debt. So there is a tendency to use that subsidy when it's available. So, long answer to your question, do believe that an increasing percentage of public to private or public-private partnerships will occur, but I don't think in the next 5 to 10 years that we should expect to necessarily see a majority of infrastructure in the country that is currently operated by the public sector to move into the hands of being operated by the private sector.
But bottom line, there'll be a reasonable amount and probably some interesting deals, I would imagine.
Plenty of attractive opportunities for investors like yourself. Plenty of opportunities.
You may have already answered this, but I was very disappointed that the tunnel that was being contemplated between New York and New Jersey was shot down by Governor Christie. He felt that they didn't have the money, but then the monies were used for something else, I'm told, in New Jersey. But that's a massive undertaking, but that would really do a lot for the economy in this metropolitan area. Is there any hope for something like that being done in this context of our conversation?
There's certainly potential. That one is a little bit harder because it's more difficult to draw a line from the revenue source to the capital source. And in the end, capital requires a return on investment to flow. And
there are fees charged when one goes from New York to New Jersey now.
Absolutely. And so, but those fees would have to be increased pretty substantially for it to make economic sense to investors like yourselves. I think the more likely opportunities are in the electricity and gas distribution space. I think the other opportunities are in the ports space, which are already operated, in a mix of private and public sector. There's a tender right now going on at LaGuardia for refurbishment of the main terminal at LaGuardia that will involve private sector investment and involvement.
What was the project in Miami area? Wasn't that similar, though?
There's a Miami Port Tunnel. There's I-595 toll road. There have been some similarity, but in the Miami Port Tunnel, the revenue source is less a commuter rail link and much more a rail link moving goods, containers through the ports. So it's easy to raise rates because it's an industrial. You're charging truckers and rail and shippers, and manufacturers of goods a price to be able to move more goods more efficiently through a tunnel, and that's an easier economic discussion to have than raising rates for commuters between New Jersey and New York. If I could ask you to move to pages 8 and 9, because it's timely, because you've been asking about opportunities and where we see the opportunities. And pages 8 and 9, I think, describe some of the significant opportunities that we see. First, I want to share with you what we view as the macroeconomic backdrop. Our view, and these are important assumptions because they, I think, might inform your judgment as to where you'd like to invest. And to cut to the chase, economic growth in the OECD countries will be low for the balance of the decade. We're thinking on average 2% per annum, and this is a position that we've had for 2 years. Now, some years might be a little higher, some years a little bit lower. Europe might be a little lower, the U.S. might be a little bit higher, but we're talking 2% per annum average GDP growth over the next decade. Inflation. We're not concerned about inflation in 2013, maybe not even 2014, but given the tremendous measures being taken by central banks in Europe, what the Fed and Treasury have had to do here, there are concerns about inflation potentially beginning in around 2015. And we're not talking the double-digit inflation that I remember from the late 70s, early 80s. All of you are too young, but that double-digit inflation was horrific. We're not expecting that extreme, but if you're only growing at 2% GDP growth, even 4 or 5% inflation really hurts. Really hurts. If you're growing at 8%, like some of the Asian economies might be, then you can handle 4 or 5 or 6% inflation. But that could be very painful. So we would urge you in whatever strategies that you invest in that you ensure that the types of investments that are being made do provide some inflation protection. And most infrastructure assets do, but not all infrastructure assets do. The strategy undertaken by your manager has to be pursuing assets that do provide protection against inflation, because it's very harmful if and when it hits, and it may hit this decade. If we look at the subsectors on page 9, we think there are attractive opportunities in the United States. In the water and wastewater sector, there are 50,000 independent systems in the United States, highly inefficient. There needs to be a significant amount of capital investment, best practices, new technology applied to the water and wastewater sector in the U.S. We made an investment in California, Texas, and Alabama in that sector. This is where a lot of the demographic moves are happening. People are moving to those states. They are dry states. The temperatures have been very high, if you've been reading the papers over the last several years, and there is significant investment needed there, and we believe that there will be opportunity to bring in the private sector to make more investment in the water and wastewater sector. The upper right-hand corner is the oil-to-gas price ratio, the discovery of large deposits of shale gas in the United States and tight oil, shale oil, is going to make the United States a net exporter of liquid energy within the decade. I think Exxon, we've been saying this for a couple of years, but I think Exxon came out just in the last week or two saying that by 2020 they expected the U.S. to be a net exporter of liquid fuels. And we're not saying all of the gas that's been discovered will be extracted, but the deposits that have been found are so huge, and many of them are far enough away from any sensitive ecological areas that we believe that gas will continue to be far cheaper than oil for the next 2 decades, and that creates an opportunity of converting current businesses and homes that are using oil or propane, and even in some states electricity, expensive electricity, to heat their homes and businesses to gas. And gas, as it burns, is much more ecologically, not only is it economically advantageous, as much as 50% cheaper than oil or propane, but it's ecologically far improved in that it emits 30 to 40% fewer greenhouse gas emissions. If we look at the bottom left-hand corner, this is 40 years of data on allowed returns on equity in the United States. The upper lines are natural gas and electricity ROEs. This is a simple average of all 50 states and the FERC. The bottom two lines, the orange and blue, are 10-year U.S. Treasury rates and 10-year investment-grade utility bond interest rates. And this is over a 40-year period. Simple average, meaning we haven't optimized the portfolio. We haven't given you the data for just the best states to invest in. We've given you a simple average of all the states. As you can see that the average ROE allowed today for natural gas and electric utilities is in the 10% range, return on equity. Interest rates, as you know, are quite low. The gray bars are recessionary periods, and what you see is that even during recessions, we haven't had a significant decline in allowed ROEs. That's because prudent regulators know they have to offer sufficient return to attract the capital investment to ensure that our electricity systems and our gas systems are operating properly. As we continue to grow the economy over the next several years, and as central bankers allow interest rates to rise to their more normal levels, and that may not begin until 2015, 2016, based on what Bernanke has said to date. But as that happens, and if inflation arises, we would expect not only interest rates to rise, but we would expect allowed returns on equity to rise on regulated utilities. And that's why we like regulated utilities quite a bit in the United States. And even in the 70s, when interest rates rose to double-digit levels, when we had inflation at double-digit levels, we had a double-dip recession in the late 70s, early 80s, ROEs on electric utilities in the U.S. rose to an average of 16% spread, a positive spread over 10-year bond rates. And the last bottom right-hand corner there just displays what I've said earlier, that transportation assets, as you move to the right of that chart, transportation assets are more economically sensitive than regulated utilities. So you have to be disciplined in terms of the price that you pay, so that you pay a lower price so that you can earn a higher return. And then when you blend those economically sensitive transportation assets with regulated utilities, you have an attractive total return on your portfolio. So if we move to page 10, we see this as a very attractive time to invest in infrastructure. In a way, you are very advantaged not having invested prior to the financial crisis. During the financial crisis, we did suffer some significant extremes in a lot of subsectors, even in some of the transportation subsectors, infrastructure subsectors, and having not invested prior to that crisis, you and your managers are able to observe exactly how different assets behaved during the most severe part of this economic and financial crisis that we've been working through. So, to a point made earlier, budget deficits in the U.S. and austerity measures in the EU will continue to generate a growing degree of infrastructure opportunities to invest in. There's inefficiencies in the U.S. water industry which will generate opportunities. If we have higher interest rates and higher inflation, regulated utilities will, with a bit of a lag, start to increase rates. Natural gas has a significant advantage, and there's significant investment required in the United States to take advantage of that gas. And we think that transportation assets are priced today at a level that generate an appropriate return. What I have in the remainder in the...
You may have touched on this. Talk to me about the performance, historical performance of toll roads and parking investments.
Sure.
And I don't know if that's just domestic or what it looks like globally.
Yeah, I can talk about them both domestically and internationally. Toll roads are, there's a spectrum of how monopolistic these assets are. So I would say parking in general throughout Los Angeles, throughout New York City, is not infrastructure. It's closer to real estate. It's not a monopoly. There are many different providers of parking services in the city of New York. But toll roads in very densely populated areas are more monopolistic. There are alternative roads, there are free roads you can use, so it really depends on how densely populated that area is. And that's another reason why we like to invest in mature assets that have a 20, 30, 40-year history, because we can see how these assets have behaved during various economic cycles. We can see how monopolistic the characteristics are. We can see what type of traffic has used the roads. Is it more truck traffic? Is it more individual vehicular traffic? And so these factors are important. So starting with roads, roads in very densely populated areas like Highway 407, which circumnavigates, which passes over the cross of Toronto, over the top of Toronto, where I'm from. Very densely populated area. There are lots of free alternatives, but the free alternatives take 2 or 3 times as long to bypass the city. That road experienced virtually no decline in traffic during the worst of the last 5 years. I think there was one quarter where they were down 0.1%. Other roads, like the Indiana Turnpike, less densely populated than, say, the Chicago Skyway, which is sort of in between. It's sort of a bypass of Chicago. The Indiana Toll Road did suffer a decline in traffic of as much as 10% one quarter. On average, it was around 5 or 6% decline in traffic. Some of the challenges some of you may have read with the Indiana Toll Road is that they were financed, the acquisition, the investment was made, and it was financed with debt to a very high degree of leverage prior to the financial crisis. And so that leverage, a high degree of leverage, combined with a decline in traffic of even 5 or 10%, is putting pressure on meeting the debt covenant tests on that traffic. So it's
who levered it up? Who sold it?
The investors levered it up. It's public information. It was a 50-50 investment made by a Spanish toll road operator, Sintra, and another infrastructure manager, Macquarie Bank out of Australia, who levered it up. And I think that was a function of a lot of low-priced and easy availability of debt, and perhaps forgetting that transportation assets are more economically sensitive than regulated utilities. We would not recommend that degree of leverage. You can take anything that's good and lower risk and make it much higher risk by putting too much leverage on the asset. Parking is even less, I would say, monopolistic, but some parking assets. Recently, Ohio State University entered into a public-private partnership for their parking concession. 65,000 full-time equivalent students at Ohio State University. Parking is a monopoly, if you will, on their campus, and that was done recently. So parking really, and toll roads really depend on location, how densely populated, how economically sensitive, how price sensitive those assets are.
I'm conscious of how much time you had allotted us for this presentation. I know we're somewhat over, so I would leave it up to you in terms of how you would like to direct us. Would you continue to want to go through Q&A the way you have, or would you like to cover just one of the case studies that we have, or how would you like us to proceed, knowing how much time we've taken?
I just have one quick question. What is the commonly used metric, or a commonly used metric? So many dollars invested in real estate equals so many jobs. Is it $50,000 per investment? Just, I think that kind of gets to one of the issues that is of paramount importance, is the amount of jobs that could be created in a real estate, in an infrastructure investment program.
Yeah, I wish I could give you a simple metric. I'm going to duck that question because I don't have that figure. The truth is, it really does depend. I mean, are you talking a totally new development of a new tunnel between New Jersey and New York? Are you talking about acquiring an existing toll road and refurbishing it to improve, to improve the maintenance on it? And so the number of jobs created will vary quite dramatically. I will say, though, that we believe strongly, and what I've experienced, around the world, is that investment in infrastructure does create jobs. It net is a creator of jobs. Our largest, actually, investor base is union plans. Over 25% of our investors in our core infrastructure strategy are union plans. Most of those are U.S. union plans. That was, and also very true in Canada when I was managing infrastructure investing there for the Canada Pension Plan Investment Board. There are jobs created in constructing or expanding infrastructure. There are jobs created in properly maintaining infrastructure. Unfortunately, there's been a lot of deferred maintenance on infrastructure. And there are jobs created because of the productivity, the competitiveness that is enhanced by investing in infrastructure. That creates jobs. If you improve the logistics, the speed with which a container gets from point A to point B, a manufacturer and a retailer will pay for that. Will pay for that just-in-time delivery. And that creates jobs. That productivity and competitiveness allows you to compete better with other countries, with other jurisdictions. So there is no doubt in our mind, and no doubt in our investors' mind, and we see it in our own investments in our own portfolio, that investing in infrastructure does create jobs. But I don't have a metric for you. I'm sorry.
What's your internal benchmark for your core and your opportunity funds?
Our clients use a variety of benchmarks, but I'd say 3/4 to 80% of them use an inflation plus, a CPI plus benchmark, because our strategy does focus on providing inflation protection, our core strategy. That's 75-80% of investors do use a CPI, anywhere ranging from CPI plus 3.5 to CPI plus 5 or 6.
Core or opportunistic.
Exactly right. Opportunistic would be CPI plus 6, for example.
The one aspect that you did talk about, value add, in your portfolios, would that tend to be in the opportunistic as opposed to the core? Or
No. In our portfolio, what value add means is that up to a third of our assets would be assets where we could expand them, but they're expanding a core asset. Okay. So we wouldn't be investing in opportunistic assets. That's outside of a core strategy. We call it core plus. We call it core plus strategy. It's because we can expand core assets. And we've done that, for example, in our Summit Utilities asset. We did it in our airport asset in Australia. We expanded the domestic terminal, just all to generate more revenue and more return for our investors.
Thank you. Can you comment on the different investment vehicles that would be offered, what you see as making sense, particularly for a fund like us at our stage and capacity, private equity, stocks, the blend, the characteristics and shortfalls of any of them?
Well, I don't want to be presumptuous and suggest what's appropriate for yourselves. I don't have the same knowledge that your staff or that your consultants do across all of your portfolio, of your risk tolerance, your return requirements, and so on. But I will tell you what we've seen in many other clients, around the world. We are one of the early movers in the United States in terms of bringing infrastructure to the U.S. Investment universe. So there may be some things to be gauged from what others have done. And why we started in the core space. When I moved from Toronto to New York, the first strategy that we started with was in the core space. We've been, as a firm, in the real estate space for over 40 years. And we started 42 years ago offering core real estate strategies to our investors. Today, the firm manages over $50 billion in real estate strategies. Over 3/4 of that is core, but we've since added value added. We've added opportunistic strategies in the U.S. We've added those in Europe. We've added those in Asia as well. Similarly, with respect to infrastructure, we felt that because it's a new strategy or a newer strategy for our clients in the U.S. and most clients around the world, the U.S. isn't really that far behind investors in other parts of the world. And we felt that most investors, and we went out and talked to investors before we launched this strategy, and what investors were telling us was that they would like to start in the core end. They'd like to start at the low risk end of the spectrum. And as they became more, they were really focused on low volatility returns and would like to start at the core end. And then over time, as their experience with infrastructure grew, they might be interested, as they were in real estate, with adding value-added strategies, adding opportunistic strategies, taking more risk, shooting for capital gains. We believe strongly that to invest in infrastructure, you should be focused on private markets as opposed to investing in listed infrastructure securities. And that is not that investing in listed securities is wrong. It's just that the biggest factor that impacts risk or volatility with respect to listed securities, whether you're infrastructure securities or whether you're technology securities, is the overall market volatility. And we saw correlation of subsectors go to 1, in the most recent financial crisis. The beauty of investing in core infrastructure through the private markets is that you have direct access to the cash flows. So you're not focused on the volatility of the stock prices, liquidity of investors and whether they want to sell or buy. You're rather focused on how volatile those cash flows are. And I don't know if we have it in here, but we have 25 years of data that shows, here it is, it's on page 25. We've got some of the best research we think that exists in the industry. This is a way to get to the end of the presentation. Page 25, the blue line, is the growth in cash flows of 229 assets, infrastructure investments in the U.S. and Europe, Western Europe, across 6 subsectors, 3 regulated utility subsectors and 3 transportation subsectors over 25 years. And what you see is that the cash flows have grown with very low volatility, and they've grown at twice the rate of inflation of CPI. That's the orange line. And we've also seen that they've grown at twice the rate of nominal GDP growth. So low volatility, growing cash flows. If I overlaid a picture of any of the publicly traded infrastructure indices, with infrastructure, you see a lot more volatility. So that's the beauty of investing privately, directly, in a diversified portfolio where you have direct access to the cash flows. You have cash flows that grow with low volatility at twice the rate of GDP growth, at twice the rate of inflation. Now, the last part of your question in terms of what structure, so what we've seen is investors prefer to start with core before they go to opportunistic. What we've seen is investors prefer private direct in order to have this low volatility return rather than publicly traded volatility. And what we saw, we have a culture of offering core strategies and core plus strategies, that is JP Morgan Asset Management, through open-end perpetual funds. And so we offer opportunistic strategies through closed-end funds. That's sort of a private equity style fund, a 10-year closed-end fund. We felt that those investors who want to invest through a closed-end fund, that's fine. However, we felt that offering the investors the opportunity to invest through an open-end fund gave them a lot more flexibility and was perhaps more appropriate for a core strategy. If you have an investment which matches your liabilities, exceeds your actuarially required rates of return, why would you want to sell that asset? And so a closed-end fund requires that assets be sold every 10 years, sort of 6 or 7 year holding period. When you buy and sell assets, you generate a capital gain over a shorter period of time, but you have all kinds of costs, tax costs, legal costs, investment banking costs to buy and sell that asset. You have a leakage in returns. And you also have what we call reinvestment risk. Okay, great, you get your capital back, but then you've got to find another investment that meets your risk-adjusted return requirements to match your liabilities. So we felt that offering an open-end perpetual fund for a core strategy was something that investors would like to see. That's what our investors were telling us, and so we offer this Core Plus strategy in the OECD through an open-end perpetual fund. So if you want to be invested in it for 7 years, that's fine. If you want to be invested in it for 20 years, that's fine too. You have the option of doing that. In a closed-end fund, you don't have the option. Those assets are turned or designed to be turned every 7 to 10 years. And again, we're not against closed-end funds. We do use a closed-end fund for our Asian strategy, which is that opportunistic strategy seeking higher return over a capital gains type return over a shorter period of time, but taking on higher risk.
Yes. Thanks, this is helpful. You highlighted the water industry. I'm just curious about that. How would you see opportunities to invest in that? Are there sort of managers that would create private equity opportunities for those investments?
Well, it's a little different than, say, electric utilities. I mean, in the U.S., 60 to 75% of electricity and gas is delivered by the private sector through regulated entities, and 25% is delivered by municipally owned entities. In the water sector, it's kind of the reverse. 65 to 75% of water and wastewater utilities are actually owned by municipalities, by government agencies, and only 25% are owned and operated by the private sector. However, there's plenty of opportunity in that private sector. What we're seeing is two things. We are seeing increasingly, we've been invited by certain cities and municipalities to bid on operating their water and wastewater system and making the capital investment required through a public-private partnership over a 30, 50-year period. But we're also seeing other private sector, other municipalities, and some private sector operated water and wastewater systems where the owners want to actually just sell the water and wastewater system. And we're seeing that particularly in California and Texas. The capital investment required to service the growing populations in those dry municipalities, the municipalities just don't want to have to deal with the cost of investing in building out those systems and properly maintaining them. So we are seeing opportunities, and we did make an investment, as I say, in a water and wastewater company that owns outright regulated water and wastewater utilities in California, Texas, and Alabama, and we expect to be adding to those with other municipalities' water and wastewater systems over the next few years.
Go ahead, Al.
So I guess you'd answer this question differently depending on what kind of investment you make, whether it was in a fund or a co-invest or a direct invest. What's the percentage of failures you have in these kinds of investments?
There's actually I would say a relatively low percentage of failures because these assets are assets with monopolistic characteristics. It depends on how you define failure. If failure means not generating sufficient return, then there's more failures because they are operationally intensive assets. I mean, they do vary. A pipeline, okay, you just turn it on, turn it off, but an airport, you got to operate it. There's all kinds of things that you have to do to operate an airport. So they do require a significant degree of experienced operational management. But generating an actual loss in a core strategy, I'm not talking about an opportunistic, but generating an actual loss of your principal is difficult. It can be done. It can be done, and we've seen it done. Usually it's been done where a manager has put on much too much leverage. And there, in fact, have been managers who have gone out of business, if you will, during the most recent 5-year period, with the crisis being the worst it was in 60 years. We have seen some managers go out of business and their assets being picked up by others at a discount to not only their equity value, where the equity was written off, but sometimes banks had to take a little bit of a discount because they had put too much leverage on it. But it's a prudent manager who is disciplined, who doesn't put too much leverage on the assets. It's very difficult to actually suffer an economic loss, although it is easy to not generate your target rates of return. And that's where, again, you separate the better managers from, the not as good managers. It's just like any other investment strategy.
And if you describe the, I guess, progression of investments that the Canadian firm that you work for,
right?
Can you just describe how they developed to where they are today?
Sure.
Real briefly.
And this is, and you mentioned co-investments, so I think it's probably relevant to that. We, the Canada Pension Plan Investment Board is the investment management firm for the National Social Security System for Canada, the Canada Pension Plan. Our strategy was very simple: crawl before you walk before you run. And so what we did first was we did a lot of research. We made allocations, much as you're doing, a lot of research, made an allocation to infrastructure. We started in the core.
Did you do that with a consultant?
No. The Canadian, we crazy Canucks, the large Canadian plans, known as crazy Canucks, not just because we like downhill skiing, but the large Canadian plans tend not to use consultants. But it's a different governance dynamic in Canada than it is in the United States. It's,
Then what kind of infrastructure what kind of staff infrastructure did you have?
Well, when I started, very few, but I can tell you today they have 50 staff. But just to complete the story, we started in the core end of things through experienced fund managers, and there weren't very many, but we were always open to co-investing and direct investing. And the strategy, which by the way was the same strategy we had for private equity and for real estate, I was responsible for all private market investments at the Canada Pension Plan Investment Board. And it was the same strategy. First, invest through experienced managers. Don't try and recreate the significant knowledge, experience, and expertise that they have and network around the globe. Then, as you get to know those managers that you feel have a closer alignment of interest to what your needs are, who you can trust, then start co-investing with them. And that also suggests that you're going to build your own team, because you can't co-invest unless you grow your own staff as well. Then co-invest, and then over time, if required, consider being a direct investor. If your staff is large enough, if you get enough experience, if you have the risk tolerance for doing that. And that's in fact what the CPP Investment Board did over a 10-year period. I joined them in 2000, over a 10-year period. So first 3-4 years was investing purely through funds. The next 3-4 years involved funds and co-investments. And then the last 3 or 4 years, they have been making direct investments all around the world.
How long have they been doing that now?
Since 2000. Well, 2001 was our first infrastructure investment. Was their first infrastructure investment.
2001 was their first.
Yeah. Sorry.
So they just recently started doing their own deals.
The last 3 or 4 years. Yeah. Yeah.
And how's that turned out?
So far so good, but remember they have 50 people doing infrastructure. They have offices, by the way, in London and Hong Kong. So they're not, they have the ability they have a governance mechanism and a compensation mechanism that allows them to attract they have 800 investment professionals on staff. These are just investment professionals to manage $160 billion or so. So it's a very different organization, so if you can invest in attracting and retaining capable staff, then that is an option available to you. So that is an option over time.
Quick question: they have 160 investment professionals, and 50 of those are devoted to
800 investment professionals. 800 investment professionals. Yeah, and 50 of those are devoted to infrastructure. Their allocation to infrastructure is about 10% of their total portfolio. Another good... Sorry?
Crawl, walk, run.
Yes, exactly. Crawl, walk, run. Yeah. One step at a time. We'd be happy to help you get there. We'd be
Okay, any more infrastructure?
Actually, another question. Could you, of our peers in the U.S., say $20 billion or more, how many of them have infrastructure programs, and where are they kind of at in that?
It's growing tremendously just in the last 2 years. So I would say I'm going to ballpark it as middle of the pack. Some folks like CalPERS and CalSTRS started at least devising their policies about 5-6 years ago. This year, this is anecdotal. I know that your team has given you some data on allocations that other plans have made across the U.S., but I would say this. In the United States, this year, new allocations and commitments to infrastructure came out of states of New Mexico, Virginia, and Florida, all in the second half of 2012. So you're not far behind those. I would say overall allocations to infrastructure amongst Canadian plans are between 5 and 10%. In the U.S., less than half of 1%. So the U.S. in general is much earlier to infrastructure as an investment strategy. But you're not too late to the game. It's a very good time, having just come through the financial crisis. You're not too late to the game. There are attractive opportunities, but a lot of other plans like yourselves are starting to look at it because of the characteristics that infrastructure offers.
I would say also, going back to David's point that Mark commented on in terms of sort of the nominal returns of that 10 to 12%, a lot of the plans that we start to see coming into the infrastructure space, particularly core, is primarily driven by trying to find yield, which is typically about 6%, 6 to 8% in a core strategy. So as we come into 2013 and as we saw in 2012, as Mark has commented, we're starting to see more interest in infrastructure, core infrastructure, for those reasons.
Yeah, that's a good point. A number of our clients are looking to replace fixed income because they're very concerned about the outlook for returns in fixed income with something that offers growing income in the form of infrastructure, core infrastructure equity. And some others are actually saying, thank goodness the equity markets have come back almost to their pre-crisis highs, but we'd like to take a little bit of that risk off the table. We'd like to de-risk our portfolio, invest in something that offers lower volatility. So we are seeing significant growing interest in the sector.
Could you talk a little bit more about that 10% return? It just feels like there must be a lot of leverage. There must be an awful lot of expenses to be dealt with. And if you took out the leverage and the expenses, what would you end up with?
Well, if you took out, there needn't be and shouldn't be a lot of leverage. The leverage you should expect in, say, a regulated utility asset might be 60 to 70%. The leverage in a transportation asset or a contracted power generation might be in the 40 to, depending on the asset, as much as 60%, but significantly lower than what you'd expect for regulated utilities. The return, I showed the slide there that suggests that the average ROE allowed in the U.S. on equity, return on equity, for regulated utilities in the U.S. is 10%, some higher, some lower. That assumes a 55% leverage ratio. So what would the return on assets be without leverage? Be closer to 7 to 8%, depending on the utility. However, you would never invest in an infrastructure asset with no leverage. I agree, you shouldn't invest with some of the high levels of leverage that others did during the crisis, but you would never invest with no leverage. A regulator, for example, virtually requires that you use debt in your capital structure because they're not going to pass on the costs of financing your utility with 100% equity, because equity costs more the cost of equity is more than the cost of debt. So a regulator will not allow a capital structure or allow you to pass on rates to consumers assuming 100% equity structure. They assume that you're going to have an efficient capital structure of 50, 60, in some cases as much as 65, 70% leverage in your capital structure. So that's the leverage you're going to want to use. And it's very rare that there are any problems with that degree of leverage in say, a regulated utility. The problems have been in the transportation sector, where from time to time over the past 10 or 20 years, the odd manager put, in the nature of 80, 90% leverage, in some cases 110% leverage on assets because they were expanding infrastructure, and they thought, oh, by the time we finish completion, we'll have more utilization of that asset and we'll have more revenue.
Okay, so shall we wrap it up with one final question? David, I think you had one.
So you mentioned Florida, Virginia, New Mexico that had made investments recently, second half of the year.
Yeah, made commitments to funds. They haven't actually.
Right. So,
yeah.
What was the process leading up to them doing that? What, if you know, what type of education did they go through? What type of discussion on IPS? What type of advice? From inception to being ready to make investments, and I know they're not all created equal. Some are sole trustees, some have boards, but I'm just trying to get
I'd say that's a good question, and Steve, please pipe in. But I would say we are familiar with all of those processes. We participated in them, and all of them involved a process much like NYCERS has undertaken and the New York City plans have undertaken. A process of hiring someone on staff whose mandate it was to research and learn about infrastructure and educate and discuss with the boards or the board or the trustee or trustees of the various plans. The staff and your staff, I have to be complimentary to your staff because they've done a very good job in the time that they've been on board, canvassing the marketplace. There are today a lot more infrastructure managers than there were 10 years ago, 12 years ago when we started at the Canada Pension Plan Investment Board. So a lot of education, meeting with managers, all the managers that are available, learning from them, hiring consultants. In two of the cases, they hired a consultant to assist them. In one of the cases, they did not hire a consultant. I don't want to share which one that was, but they did not hire a consultant. They did the work internally. In that case where they did not hire the consultant, the person who is responsible for real assets had a real estate background initially, but they've been looking at the infrastructure space for 5 years. About 9 months ago, they hired 2 people to join that person's real estate team to focus on infrastructure, and they got themselves educated. They've been spending the year meeting with managers, and then the next phase after the education, after in some cases hiring a consultant, was to develop a policy, approve a policy. I understand you're in the process of considering at some point a policy. And then after a policy is approved, going out and interviewing and having managers usually present to the staff, and then the staff making a recommendation to the investment committee or the board about which managers to hire for infrastructure investing.
Okay, well, thank you very much, Mark and Stephen, for your time. I'd love to enlist you as we move further into the process.
Our pleasure. Thank you so very much. Thanks for having me.
Thank you, man. Go Cheesehead. Is that right? Fantastic.
Sorry. Yeah. I think everybody's blood sugar.
I did.
Scanned. Okay, waiting for the council to come in.
And Cortland. And I'll see if we can get through this.
You know the voice doing? I was there. Yeah.
Canadian guy.
It just went up the last minute. Talk about wasting $1 million.
Let's go. Changing fly on the fly here forever. Steve, close the door. Let's go.
This is not mine. This is mine.
Ivana, we set up? I mean, Petya? Set up? Okay, let me see if I can set this up, set the stage a little bit, and then I'll hand it over to Petya, Steve, and Steve. So, as you may recall, in January through last June, in 2011, we went through an asset allocation, and as part of that asset allocation, we said at some point we might get to infrastructure. And also, I think it was in the June or July board meeting last year, the board approved a series of additional staff additions to BAM, two of which were going to be infrastructure. BAM hired Petya and Evan in the last several months. They've been working initially by themselves, then we enlisted our consultants to help us sort of pull together infrastructure. We've kicked around the concept of an asset class, and we've come away, as we've discussed before, with the thought of infrastructure is a real asset, real estate is a real asset. In the future, perhaps timber and energy assets are real assets. And the fact that we have a 6% allocation to real estate, of which only about 4 is in the ground, and we all agree that sort of setting up a new asset category takes 3%, otherwise it's not worth the effort. So we concluded that why don't we just have something that we'll call for now real assets, include inside real assets real estate. Again, we've got 4 of the 6 invested. Add infrastructure in there and add the other asset categories as we get there, but basically change our real estate allocation to real assets. We talked to Callan about it, we talked to Townsend, Cortland about it. It seems like a reasonable approach. We're kind of, I guess we're 9 years into real estate, does that sound right?
That's about right.
Yeah, so we're 9 years into real estate and we're only 2/3 of the way to the allocation. So these things take a while. You know, if you commit to funds, it'll take us a few years to commit to funds, and they have to invest the capital. So adding a new illiquid asset category just takes a lot of time. So if we get the infrastructure machine moving, and the real estate machine is also moving, we can revisit the 6 and increase the 6 as we all like it, but then the 6 has to come from someplace else. So what we did was we started with the real estate IPS, which we were going to review anyway, and basically made that a subcategory of a real asset IPS. So you kind of have an overarching IPS that says real assets and the goal of real assets. Then you have a subcategory called real estate, which is really an updated real estate IPS. Then we created a new one, subcategory called infrastructure. That has an IPS. And the extent we have more sub-asset categories, we'll have more sub-IPSs. But before we get to the IPS, what we want to talk about was, okay, if you're adding something new to the gumbo here called infrastructure, what does it do to our expected rates of return, our volatility? It's a big word, infrastructure. There's core, there's non-core, there's value, core plus. So we wanted to have Townsend, Cortland talk about that, as well as Callan, put it on the table, get comfortable with the concept, and then get to the IPS, and hopefully today approve an IPS, which again, if to the extent we want to keep fiddling with it, which we can do with all of our IPSs, we can keep tweaking it as we go forward. So why don't I hand over to you, Steve, let you get us marching.
Thank you for the introduction, Larry. I compliment the board on thinking about this now as real assets as opposed to just real estate. I think it's a good concept. We've noted over the past 5 or 6 years, if we have 74 pension fund clients, which I believe is the true number, now I believe 13 of those have moved from a real estate only program to a real asset program. And in speaking with Steve, I believe Cortland has seen the same type of movements, and I didn't have a chance to debrief with Callan this morning, but I'm assuming that that's true there too. Why is this happening? There was a very interesting article that was published, and in fact, the gentleman you just met from J.P. Morgan might have hit on some of this, but I just want to quote from a summary of an article that was published by JPM. History shows that secular changes in the investment environment force dramatic changes in asset allocations. Low bond yields, along with outsized equity market volatility and modest equity returns, have brought us to a new asset allocation tipping point. Global real assets, real estate, infrastructure, transport, and natural resource assets that can provide higher income than bonds and superior risk-adjusted returns to equities will increase in size and importance in investor portfolios. And in the next decade, we believe real assets will move from an alternative to a mainstream asset class. Portfolio allocations could rise from roughly 5 to 10% today to as much as 25% in the next decade. I fundamentally, in speaking for Townsend, we agree with that. We think that this is a movement. As recently as the summer in July, I was with the United Nations in Paris, and we adopted a real assets approach where they grew the portfolio from 6 to 10% to incorporate infra, timber, and agriculture. With that, I'd like to move now into more formal comments. I'm going to work off of this PowerPoint, and I'm also going to work off of your IPSs, which begin at page 137 of your books. And given the fact that we're going to deal with 3 IPSs, I'm going to move pretty quickly, but obviously feel free to interrupt with any questions you may have. In the PowerPoint, on the first page, the second heading, strategic objective of real assets. This is not going to change asset class to asset class in the real assets. You've seen this before from us when we've talked about real estate. What are the goals? Preserve investment capital, provide a hedge against inflation, diversify the broader portfolio by dampening volatility, provide attractive risk-adjusted returns. That is the why. That is why you would want to do this. On the next page, page 2, we talk about diversification. And if you'll note, down the left-hand side, you have a variety of different indices. The NPI representing real estate. You have a global infra index. You also have a private infrastructure composite that we create. And then the S&P and some others. And you'll note low to negative correlations throughout that chart. That's what you're seeking to do, to have asset classes in there that really aren't going to act like your fixed or like your equities. On the next page, we're not in an inflationary period right now, but I can't imagine that we won't be at some point in time. Quite simply, and I'll use the example of real estate, a lease, if you consider that goods and services, it will move with inflation, so it will go up. And I think on the right-hand side, we've taken you through a variety of different real asset classes. Those are the bar charts in green. And as you can see, a nice correlation there when we hit an inflationary period, and that'll be the true test. Competitive risk-adjusted returns are highlighted on page 4. And obviously, we didn't put the private infra in there. I'd be interested to see what that is. Over 10 years, this is a long study. And it basically, I think, proves out the case that you can obtain some superior risk-adjusted returns. That basically is the highlight film for the real assets, IPS, but if I could ask you briefly.
Isn't private infrastructure something we should be seeing as far as the return profile? From what I'm hearing,
yes,
that would be the more likely path that we'd be headed versus public.
Yeah.
So it would be important to really get, a feel for those returns.
Sure. Those returns are positive. There's not a robust set of data here, David. I mean, it just doesn't go back that long. It really doesn't. And I could share those with you, but they are positive.
But even if they're 3 or 5 years, I think it would at least give us a data point from which to work
Absolutely. I don't think it's in this book, but I can get it for you. And I know I'm pretty sure when we did our infra educational piece, we shared at that time, but I apologize, it's not in this one. On page 137 begins the real assets IPS.
To David's point, or to Dave, what I infer his point to be, as much as infrastructure assets are set up perfectly for long-lived liabilities like we have, which is why the Canadians kind of own them directly, as do the Aussies, as do some Singaporeans, etc. The funds that you invest in actually have a pretty limited universe of realizations. So what you're looking at, if I take it to the private equity analogy, people went out and invested a lot of money, bought a lot of stuff. The way they're set up, they pay you a yield of sort of 5 or 6%. It's not obvious that you get the terminal value when you sell it, because there hasn't been that many sales. So if you go out and buy Gatwick Airport, great, it's a deal, it's in our funds, we paid X, we got a 5% dividend, you still got to turn around in 5 or 6 years and sell Gatwick Airport to somebody, right? So when you look at a class like infrastructure, there's not, like in the real estate business, decades of returns to look at to get comfortable. So there's a little bit of a leap going on that you're going to get your total return. You're going to get your coupon, but it's not clear you get your coupon and your money back plus a return that you're looking for. So if you believe it's a 10 to 12% return asset, you know you got your 5% coupon. Did you get your money back plus the other 5? So when you look at these numbers, that's sort of the missing, that's sort of a skeptic can look at it and say, well, yeah, I see it and I see that there's fees. It's because it looks like a private equity fund, so there's a 1.5% management fee and a 20% carry. But what is your realization? How have you done? And there's just less of that. So as much as people are piling in because everyone likes the assets, the wrappers aren't quite right, that being the fund structure, but that's kind of the development. So that does get you it's a quicker path to get to the end, which is, let's just buy Gatwick and own it for 30 years. Feels better. So to your point, there's just less of the evidence of the round trips as you'd like to.
Right, and you're right. So I'm trying to get comfortable with the leap of faith, right? As close as I can that we're going to have a return of a benchmark return of 5 or 6%, but they're talking 10 to 12%. I'm trying to bridge the gap, as you point out. We're going to be paying fees based on a 10 or 12% type of return, but we're looking at 5 or 6. And so I'm just trying to, grasp all of that, quite frankly. And I understand the leap, but I'm just trying to make it not as, a Grand Canyon leap versus others.
When we come to you ultimately with some funds, there are some people, particularly the Australians or the Canadians, managers, that have been doing it since probably the 90s. But not much further back. So they're not doing Fund 3. So they've had Fund 1 is fully realized, Fund 2 is partly, and Fund 3 is where you're at. But it's a pretty small universe, and there's an awful lot of Johnny-come-latelys. So every big private equity firm wants to have an infrastructure fund now. Right? Just like they want a real estate and infrastructure and debt and all that as they build out their money management complexes. But again, as we see it, we'd like to say managers that we bring to you aren't going to be in their first fund. Hopefully, they should be able to give you a demonstrable track record like other managers.
Is it possible to get some sort of discussion, and that's, I don't want to necessarily prolong anything, but the Canadians and the Australians who've been investing for 15 years to talk about what their return profile has been, which is the other side from what the manager will be telling us. What is the actual experience from an investor's standpoint, and just to help get us comfortable with what we're going to be
That's
looking at.
in some respect, it's almost like Macy's telling Gimbels what to do. Because please help us get up to the point where we can be your competitor.
Well, no, John.
No, I think some investors are a little more collegial.
Yeah, public information.
Well, I don't know if you, because public information.
Well, I don't know. I mean,
No,
what do the consultants say?
We can get that.
The Canadian funds have to publish their investment results for the public, just like any other public.
The Canadians, by and large, are friendly investors. They're happy to show us their information. Because, again, a lot of the Canadians are doing it direct. They'd like some co-investors. We're big enough to hang out with the big boys and co-invest ultimately. So they'd like to get you educated because they'd like to be a broader investor base.
Right, and we can be very specific. What were your early core investments like? How were those returns been? Because, that's what we're interested in. Down the line, maybe we'll be interested in co-investments and down the line direct, but, if you made an investment in a fund in 94, right? Tell us how that has been, or we can ask. I don't know if they'll tell us, but it would be interesting to get their perspective from just taking it to apples. We're making our first investment. How did your first investments go?
Always great.
Yeah. Like Reagan said, show me, but verify.
Well, actually, David, they did do that. They did that like 3 years ago.
Very well, good.
The guys came down and talked to us for.
Unfortunately, I wasn't privy to that.
Meeting, right, Pat? They came down and talked to us for like 2 hours, told us everything, and then tried to get us to invest with them before they left.
I think this is a very important forward here. Certainly don't want to tie things up in the interim, but in as much as we can put in place a navigational roadmap, which I think, David, kind of a simplistic label for what you're proposing, it's going to help, the board with continuity and us as we go about evaluating this program and getting it up to speed. Yes, we got to proceed once the time is right with individual investments, but, it's pretty provisional right now, the plan that is being proposed, and I don't think anybody believes, that that's the plan, the asset allocation mix and everything else that's going to be best for, our members 5, 10, 15 years out. So thank you for bringing that up, David.
Okay. Just whether it's page 4 or it's getting additional information from the Canadian investors, a lot of these graphs over any period in the past, especially those who began as first movers, are going to probably show things that won't be on the risk-reward frontier. They're always going to look better, and past performance is no guarantee of future performance.
What are you, the Grinch?
Absolutely. Part of my job.
That's why the Greek shirt.
That's right. I got paid and I think it's... Thanks, guys. You knew I had to say that. But it is an important element of your evaluation of these things is people, no offense, Steve, you come in, you show something like timber or agriculture making these tremendous outsized returns at no risk. Okay, fine, that's what happened in the last 10 years, that's factual. But to presume that that's what you're going to see in the future is not. And I think it's just part of building your portfolio and keeping in mind that the numbers aren't always the answer. That still doesn't mean something like infrastructure, by its nature, doesn't have the right characteristics for the fund. But don't build it off just what other people have done or what a couple of graphs show, because it's not necessarily what you will get. And what you will get, ultimately, it'll be what you get. But you should at least expect... That's true, but you should expect a risk-reward that is an adjusted risk return, and an infrastructure in the United States at least where you compete against tax-exempt capital, as was pointed out by J.P. Morgan. Why don't you have that many projects here? Most people, it's not logical for the public or anybody else to invest in some of these things. Regulated utilities, If you were willing to tolerate the volatility, invest in the S&P extra in the S&P Utilities Index. Fine, you own regulated utilities. You get the volatility of the market and the correlation. Direct investments will give you an advantage of correlation and cash flows and a different measurement. But the focus shouldn't be on past performance. The focus should be on what you can get on a risk-adjusted basis going forward and whether it correlates well. And I would encourage more discussion of that, which Pep has done a lot, rather than the focus on the historical data.
Bob,
Sorry.
you actually disappointed me a little bit. I expected you to talk about new money coming into Chase and reverting to the mean.
Well, I was trying to be nice today and minimize my Grinch image.
Okay.
But yeah, I can throw that into.
I mean, that's,
More money chasing the same thing will result in a depression of alpha in any asset class.
Well, and to Bob's point, one of the things the Canadian plan is renowned for is, approaching asset allocation with a more innovative outlook instead of, clumping investments under simple labels. They look at what's actually driving risk and return, and then they, position the portfolio appropriately. So I think, they may have had these stellar returns in the past, but going forward, they're probably pretty candid and less sanguine, and would be happy if they got 400 bips over CPI, as an example. So.
But Bob, your thesis about more money chasing the same amount of projects doesn't quite fit my view of what potentially could happen with infrastructure. Just think about the water sector. In my mind, there's an unlimited amount of opportunities in the western United States with respect to water projects. We don't know. That is not a definable area. So I don't know that your statement there fits.
Well, let me say, I think that historically a lot of things which you might not expect then come true. Everybody once thought people would always repay their mortgages until we rebuilt the system so that people taking the risk were divorced from the people who did the investing. And then we blew up the whole system. Any asset class has to be looked at for what it can potentially do under multiple circumstances. Infrastructure currently, as defined, represents something that has a consistency with our liabilities. In theory, has a consistency and a correlation that could dampen the overall volatility of the portfolio, and in theory, is supposed to provide risk-adjusted return. I challenge that part of it has to be looked at very, very carefully. The risk-adjusted returns.
Okay.
It's hard to get them. You say it's unlimited. I disagree.
Well, we
If
don't
it's
know.
really
What I'm
that
saying,
good-
we don't know that more money going into this asset class is going to dampen returns. I don't think we can say that right now.
Well, we'll see, but for the most part in history, if the profits are there to be made, the private sector sucks them up. They find a way to allocate capital unless it's really, really too big. And I don't see that happening in a lot of these things. And where it does, energy, regulated utilities, the money somehow flows there. So it's just an asset class that you want to be careful with. It has all the right characteristics, but getting the risk-adjusted returns, I think, is the real challenge. And every time you find one, kind of like private equity, you find something that's good, buy it and own it because you want it. But don't just jump in and assume that everything coming down the pike is going to pay off.
But Bob, we make investments based on an investment thesis, right?
Yes.
And that thesis has, an idea of what our returns should be. Otherwise, we wouldn't want to make the investment. So we have to, if not have hard assumptions about what we're going to make, we have to have goals about what we're going to make, right?
Yes, I just encourage realism. I heard a 10% nominal return from J.P. Morgan, but a benchmark of CPI plus 4. And there's a spread of a lot of basis points there. And realistically, is it doable? I'm a skeptic. That's all I'm saying. I'm skeptical. I'm a Grinch. I guess I'm the winter Grinch. And I encourage you just to be cautious on it. Just because you want something to be doesn't mean it will be. And the challenge in these kinds of investments is to find things that work. The people that bought the Chicago Skyway, the Indiana Toll Road, they got into a bidding frenzy and then they lost their shirts.
And we were just advised to avoid them, like the plan.
Absolutely. Avoid bad deals. And how do you determine if it's a bad deal? You're cautious.
Okay, I get it.
I'm sorry, I pontificated.
Okay, I get it.
That was my point exactly, that we've got this spread, and I'm just looking for data points. I'm not basing an investment decision based on early investors in the space who I absolutely agree will have an outsized return with a lower risk, and we're coming in a little later. The return profile is going to change. But it's very helpful to have additional data points to sort of get comfortable with that risk-return differential.
Okay, so unless there's other points in the interest of time, shall we move on?
Yeah, I'm going to go back into the big book, page 137.
And I've hit the highlights of the real assets, IPS. If you take a look at the first page, strategic objective, we discussed that. If you get through the actual allocation, 6% plus or minus 2%, the responsibilities and delegation section is there for your review. These really don't change much over the years. And then there's a section as you move forward about that entails what happens if there has to be an exception to the IPS document. With that, I'm going to now move back into the PowerPoint and talk to you about real estate. We've been at real estate now. I think the first investments, Yvonne, correct me if I'm wrong, probably go back to 2002.
2003, I checked.
2003?
That was
okay.
asked earlier.
And actually, this document, which is a living document, the IPS, has changed very little over time. In this particular round, we have a few modifications, and they're highlighted on the first page of the real estate section, page 5 of my PowerPoint. It references the benchmark change, some different thresholds, property type and geographic, which I'll get into in a moment, a change to the leverage threshold, and some refinements on manager and investment exposure. As you know, probably 18 months ago, on the following page we talk about the benchmark, we moved from an MPI-based benchmark to the NFI Odyssey. And at that moment, I think we were just the Odyssey straight up at that particular moment, gross. And then we subsequently have changed to be an Odyssey minus 100% over the net Odyssey return over market cycles. And that's what we've been operating under in the not too distant past. Your 1 year and 3 year returns have exceeded that particular benchmark. The Odyssey, the movement to the Odyssey is transpired indice-wide. It is a better benchmark for you than the MPI, and I think it's a fair and reasonable test of your real estate portfolio going forward. On page 7, we previously had geographic and property type diversification limitations, which quite frankly you could drive a truck through. It would be plus or minus 30% of whatever the market weight of the MPI for that particular property type or region was. We seek to refine it in this particular IPS with these up to statements, up to 40, up to 35, etc. We don't necessarily manage to those numbers. We try to stay close to them, and generally speaking, I think we are fairly close at most times. So that's what I would offer there. The next page, the next page is LTV. That's at 65% now. I believe this was approved by you previously. That's a good move on a projected basis. Your funded and committed portfolio is currently at 54%. Recall that we are going to proceed down a path of overcommitment. I anticipate that your portfolio will probably weight more toward non-core. It currently does for a period of time here. And also, the reason why you need the 65 is in the event of a market correction, we would most likely exceed that 50% threshold, which in the past, that's an historical item that was based upon the portfolio when it was at inception, when we were trying to make it more core and conservative in its orientation. Investment diversification is handled on the next page of the PowerPoint, page 9. I don't think there's anything difficult about that one. We're basically going to limit our manager exposure. And with that, I very briefly now would turn back into your IPS documents and highlight just a few things. This is under the real estate investment policy now. I'm sorry. In mine doesn't have, we started at 137 in your book. In my document, it's page 6.
It's page 141.
141. This takes you through, at the bottom of page 6, it takes you through your splits. Your core plus is no less than 40. Your non-core is no less than 40. No change there. If you'll recall, under discretion, BAM and consultant have limited discretion under this particular document and have had that for quite some time as it applies to follow-on funds and also core investments. Page 8, the no less than 40, no less than 40 is expressed. Importantly, under investment guidelines, real estate is not only private equity real estate. There are other things that it contemplates as well. And in the second paragraph, under investment types, we take you through the possibilities of investment. You already have exposure to many of these different things through your opportunity fund investments, but it's important to note. The next page takes you through the different ranges, risk management policies, and many of the things I described to you. Page 10 I'm on now, location, single investment size, investment position, leverage were previously discussed. How we diligence matters is on page 11. And then the performance objective, the Odyssey net plus 100 over full market cycles, is expressed on page 12. Moving now back into the PowerPoint.
Steve,
Yes, sir.
nothing dramatic in the real estate ideas.
This is really kind of milquetoast, Larry, to be honest with you. I mean, there's nothing.
Pages is on your
Yeah, I move fast. There's, honestly, the changes are highlighted in the PowerPoint and pretty modest and I think very logical. That document really hasn't changed a lot in 10 years. It's been interesting. Infra. It's important to note that the approach to infra, which calls for 60 to 100% in what we'll call core infra, is a conservative approach. We intend to proceed slowly in this arena and bring forward to you investment concepts, and obviously we're mindful of the conversation and the discussion today when we bring those things to you. We previously went through an education proceeding with you, and I understand you had a 102 today with the J.P. Morgan fellows, so I'm not going to get into greenfield, brownfield, et cetera. I think you're well educated on those matters now. The core and non-core on page 11 of the presentation, this will take you through basically what that means in both things, and it's just a highlight reel there on page 11. Importantly, we have guidelines and policies, page 12 forward. A couple of things I just wanted to draw to your attention. Leverage, it's at 65%. I think that's a good level. Understand, too, that infra operates in a different way than other asset classes. In real estate, generally, a high return fund, an opportunity fund, might allow for 75%. And that's where you're going to see your LTV ratios higher, et cetera. In infra, you can find core investments that are literally levered up to 90%. So it's just sort of a different approach. It's something that every time we bring an investment to you, we will highlight for you. I'm not saying that's the order of the day, but it seems to happen. So that's an important one.
You wouldn't recommend
On a pure core, it depends what it would be, Pat. It would depend what it would be. But generally speaking, highly conservative infra investment with leverage on it, it is done.
Like the Port of Miami Tunnel transaction that was mentioned, we spoke about at the last education session, this would have 90% leverage because the payments come from the government to repay equity and debt. So it's considered very safe. You're taking the credit risk of the Florida Department of Transportation, AAA. So it's very strong.
I'd now like to just touch upon the benchmark for this program, which was settled upon, it's recommended at CPI plus 4. Why CPI plus 4? And if you don't mind, I refer to some notes now. It is consistent with recently adopted benchmarks by institutional investors. It's in line with the investment objective of pursuing a primarily core-focused strategy. It's reflective of return expectations in the current economic and market environment. It's supported by data, obviously shorter-term data in the private market, available both through the private and the public markets. It captures characteristics that investors seek in a benchmark of being measurable and unambiguous. It's appropriate given the strategic investments in real asset, and it includes a return premium to capture excess returns from manager selection and account for illiquidity. Those are the basic overriding themes that we discussed as we were moving toward a benchmark of CPI plus 4. As an example, and this is in our client base currently, $42 billion corporate pension plan, CPI plus 4. $29 billion public pension plan, 3% over CPI. And there are two more large public plans that I have in my notes that are 3%. There are exceptions to this, and interestingly, I was speaking with the JP Morgan people before the meeting, and I said, what else do you see? I mean, I see primarily CPI plus systems. I guess there are programs out there that go off of some sort of a fixed benchmark. There's also programs that will go off an absolute return number. But those are a minority. And in a way, it sort of reminds me a good deal of 15, 20 years ago in real estate. When I entered the industry, it was very common, Steve, I think this is probably your experience too. The NACREIF wasn't well known at that moment, and it was different. And so people were more comfortable with a CPI-based. I think what you'll see is the overwhelming majority of the programs in the United States that I'm aware of are CPI plus basis. I think that'll change over time as the data becomes more robust, composites are developed, et cetera. But for now, given what we're attempting, which is a net 6.5% return, a more conservative profile, I think it's a reasonable benchmark to begin with, at least.
Steve, you weren't here for JP Morgan part, so but I think to us CPI plus 4 sounds reasonable. I think there are fundamental and quantitative issues and so forth, but the part you weren't here for, how might you reconcile what Bob had referred to in terms of sort of an overall benchmark at the fund level of CPI plus 4 with sort of a JP Morgan talking about deals in the 8.5 to 10 for core, 9.5 to 11 to 12 for value add or opportunistic?
I don't know. On a blended basis, if you consider that the core investments we're going to look at will minimally seek to obtain that net return of 6.5. I start there, basically.
Yeah.
And I wasn't present for the presentation.
Right.
Petya might actually be better able to speak to what the projected returns on many of these are. I agree. There's a difference there. And I think the difference might largely be based, quite frankly, in the prior data sets, what they're looking at, what they're projecting, et cetera. So to
some extent, it's not different from some other real estate benchmarks,
right,
which also might be CPI plus.
Sure.
Where you're looking at deals that are beyond that.
Right.
But,
I don't have a great answer to that one.
What's the consumer price index now?
It's
down to nothing.
It's actually in our charts. It's in the twos.
Yeah.
Tell me.
Twos. Low twos.
Low what?
Low twos.
Low 2. So 2 plus 4, so 6.
That's current. Yeah.
It's one of not even year-over-year basis, but the utility of CPI is historically high, so, your guess is as good as mine 3 years out. It could rise significantly. We could stay in this.
Well, it's pretty low, so one would expect it would.
A year ago was in the threes.
Oh. Thank you.
You're welcome. That concludes my formal remarks. If anybody has any...
That's a wait for Social Security. One question on the CPI plus 400. That seems pretty reasonable. I guess one item of ambiguity, the way that combines real assets, IPS is drafted currently, it's not clear as to what the total program benchmark is. Is that something that, we could...
Actually, Larry, we did some research for Larry, and we looked backward in time to determine what this would look like. And Larry, I'll turn it over to you.
Yeah, it turned out that the Odyssey net plus 100 for 10 years got us 6.0%, which was also the exact same number as CPI plus 4 for 10 years. And when you looked at 20 years worth of numbers, I think the numbers were 8.2 versus 8.4. So it turns out when you re-engineer the numbers and convert Odyssey plus net plus 100, you get to CPI plus 4. So we thought that was good. So having CPI plus 4 for infrastructure was good. So there probably should be, since they're both right on top of each other, a CPI plus 4 overall for all the real assets. We should probably put that in the preamble. And again, depending on what you add in the future, you can always tweak that around as well. Because I don't know if CPI plus 4 is timber or not, but we'll figure that out when we get there.
For real estate, it actually kind of makes sense that it would be close to that anyway. If you think about what the underlying assets are, it should be about the same.
Right. And again,
So intuitively, yeah.
Some inflation protection.
When I asked that question, it had somewhat of a rhetorical context because I knew it was low. But if what David raised earlier, if we're going to pay very heavy-duty fees, similar to the private equity fee, that's the disturbing component. We're paying through the nose, as one might say, for this asset. So.
I mean, the overall target is a net number. It's 6.5, so that takes the fees out, and the overall benchmark is very close to that. And as to the actual fee structures, that obviously BAM and the consultants work very hard to limit that. I can't speak to you right now and tell you exactly what a fee load would be in one or more of these funds, but that's certainly a consideration that you always have to take, and the board will have that option. If we can't negotiate the people down, and if you don't think the return going forward, then we pull it. I mean, it's a point well taken.
And you have different strategies, right? Core versus opportunistic, and for the core strategies, the fees tend to be lower because the assets are they need operations management, so they need asset management, but it's less than just private equity style, so the fees tend to be lower.
Are they more the real estate model than the private equity model? Sort of a base off income and.
What's a typical model in infrastructure fund for fees?
Well, again, it depends. So there is no typical model. It depends on the strategy, right?
Right.
But the trend has been similar to private equity, where there has been some fee compression over the last few years. I can't speak to real estate.
Also, it seems like there's a few other items that lead to some ambiguity on this. I guess I'm overusing that, but it seems like we're all in general agreement that infrastructure, that we want to continue to explore this. We could flesh out this IPS a bit. Maybe we consider this as in a provisional state, and the board can work with BAM, the consultants, to fine-tune this and maybe bring it back in a follow-up board meeting. Does that sound okay to everyone?
Well, I'm not sure what you're going to change in the IPS, to be honest. I'd just assume you approve the IPS, and if you today, and if you want to tweak it around, tweak it around. But I'm not quite sure what's so provisional about it, to be honest. Well, but again, you can change it, but I wouldn't want to adapt something that we all think is provisional. It's an IPS. In fact, the real estate portion is pretty much the same as we have. So I don't know why we just don't sort of deal with it and be done with it, but subject to changing things.
Okay, well, for starters, we don't have.
Unless you guys don't want to. If I look at it the other way, we won't have an infrastructure allocation if we don't approve the IPS.
And nobody's proposing to hold that up. It's just that understanding concerns voiced by the board, we want to move towards a long-term plan, and this helps us short run, but just a plan-wide benchmark. It seems like we're in agreement on that, but there is room for improvement on laying out risk expectations, fine-tuning the strategic objectives of the plan. For example, I noticed that we don't mention the fact that infrastructure provides long-term cash flows that match the liability stream of the plan. So I think there's a a lot of things that could be made clearer. We're happy to approve it in this state, but just realizing that, these things, as we move forward, there's going to need to be more clarity.
Hey, and Larry, I was wondering how ESG fit into this whole asset class. There's no mention of it in the IPS.
In the global IPS.
I know, but there's not even a mention of it in the IPS. So I would assume there would be at least.
Yeah, there is an ESG, particularly because you're dealing with the E in most of these types of things.
I mean, at a minimum, there would be a reference.
Yeah. I totally agree with you.
And then the other thing, I think once we get this in final form, I want a chance to talk to, just to explain to my principal, exactly what it is. I mean, I can start that discussion now, but I assume some other trustees need to talk to their principals about it also.
Yeah, I mean, to Al's point, this is a pretty big decision to be making, and it's the first time it's come before the board. So we don't want to do anything that's going to hold up BAM and making headway with the annual tactical plan. Opening moves and identifying managers. But I think that this warrants further consideration and discussion amongst the board.
I remember, as Al pointed out earlier, the Canadian folks coming in and talking to us was 3 years ago.
There was a very good discussion.
And I've been anxious to move ahead on infrastructure because I do think, even though I raised questions, these are questions and comments, doesn't mean I want to put the kibosh on infrastructure, because I do think it's a good investment. So is there a way where we could have a preliminary approval of this and tweak it if we wish to tweak it with some of what Al has said and others have brought up, rather than just stop at colds at this point?
So
that's what I was trying to. His word was provisional. My word was sort of approve
we'll circulate a red line
version. Keep working on it.
Keep working on it, but we're not going to hold up any of the nitty-gritty of moving forward.
Maybe along those lines, I guess sort of the way, what I'm hearing, and I think the first primary decision here is, do you want to add infrastructure as an investment? And I think I'm hearing the body of the feelings, but I think that's your first decision. I think the policy document itself to us looks somewhat, I don't want to put the word somewhat, looks reasonable to us. I think, like any policy statement, that's a living, breathing document that needs to be reviewed on a continuous basis. We will do a little bit of that. I'm sure that Townsend Portland will do the same. So I think looking at it that way may combine the two, if in fact the board is ready to approve infrastructure as an investment. That's the big question, I think.
All right. Sounds like there's one common aim, different ways of describing it, but the motion is to adopt this and it state conditional on subsequent circulating a red line version and returning to the discussion at a future board meeting. Is that
You can't come on the shares. Someone here's going to make a motion.
You okay with that?
Anybody care with that?
I mean, I've been hoping for us to start investing in infrastructure for at least 2 years. So I'm totally behind the program. I can't vote for it today because I haven't had a chance to finally let my principal know this is what we're doing. So I just need to go back and inform my people this is what we're doing, and make a recommendation to them, and then they're going to tell me yes or no. That's how these kind of large decisions work in my office.
Does anybody want to make a motion?
Yeah. Do we have a motion to approve
So
the resolution as it stands?
I'll just abstain today if you guys want to.
You got a motion,
Okay.
Let's get a motion first.
Okay.
Okay.
Hang on one second. I have a little chatter over here.
Call this.
What's that? Because it's what they normally, that's why I recommend for adoption of policy matters.
We're not talking about
Yeah, do we need to decide all that?
Well, it's up to you.
That's correct.
Some people don't give me that.
No. I know Wisedo for a long time. I know from when he was at Canadian TPP. What I didn't want was a manager to pitch. I have a feeling we would do him. So. That's exactly right. That's all it is.
Okay, do we want to call it?
I have a track record this time. But you'll see this. Like private equity, once you open this door, all these managers are going to want to be your friends. You just got to be really careful.
Jimmy, don't eat now. Watch out. How can you eat so much and stay so skinny? Oh, you didn't? I didn't have to. I eat breakfast and then I come here.
Mr. Chairman, were you trying to say something?
I've been pretty good lately. I do like the sweet stuff.
Okay, so do we have a motion?
I'd like to make the motion to approve the investment policy statement as written, recognizing it's a living, breathing document. It can and will be adopted moving forward. I am very respectful of the concerns of my friend Al Rodriguez and the concerns of all members of the board. It's an important asset category, and I think it would be prudent for us to move forward. And again, things can be added. It's a living, breathing document. I think there's enough here to move forward. Subject and other amendments and other modifications will be brought forward, and I look forward to seeing those. And on those grounds, I make the motion to approve this document.
Do we have a second?
I will second it, and I would like to add that I agree with Al Rodriguez's comment about adding ESG, and I think that that would be a very fine thing to do. I think Larry Schloss also agreed with that. Anything else that should be added, we can certainly do that, but I'd like to move forward with it as well.
And I concur. I think we should do it subject to adding ESG language and actually further definitions as far as purpose that you raised earlier.
Okay. Any further discussion?
Point of information. I think that we got to be clear about what we're voting on because it's changing and shifting a bit. And so I wanted to get some definitive language about what we're exactly voting on because I think the editorials to the motion, I think the simple motion is that we're moving that we accept the real estate investment policy subject to board input or change.
Real assets.
Real asset. Real asset, I'm sorry.
It's okay.
Thank you.
Sorry.
About to get thrown out the room.
That was to be clear, as you were saying.
Yeah, point is well taken. So I asked my only point. I think we should be clear about exactly what we're voting.
How about that the motion is to adopt the real assets IPS, recognizing that it's subject to future modification?
That's fine. Well, it's your motion. Is that okay?
Well, I like it as, I think it's acceptable as written. I'm concerned with adding too many caveats at this point. I respect what is going to be added. It's important to be added. I'm not a lawyer, so I'm not quite sure how to parse. I'm in favor of it as written, recognizing that there will be modifications to this document, and we as a board look forward to those modifications. And I'm very respectful and appreciative of Al's comments regarding the ESG, and look forward to their incorporation and discussion into this document, which, as I've said, is a living, breathing document. And I would also ask that those modifications and discussions be dealt with perhaps sooner rather than later.
Couldn't agree with you more. Okay. All in favor then?
Aye.
Aye. Any nays? All right.
Actually, I have a friendly abstention.
All right.
Just because I haven't had a chance to... just because I had a chance to discuss this with my principal.
Okay. Motion to adopt. And
That's resolution number 1.
Okay, so that ends the agenda, public agenda. So I need a motion to get out of public session.
So moved.
Shall we move to a recess?
So moved.
Let's go to the executive session.
And move to executive session, then recess. Do we have a motion for that?
Second.
All right.
You moved a second.
Okay.
Aye.
Lunch? They have to break that down. Lunch?
Yeah.